So we will be spending a lot of time on reporting overseas transactions, okay? What happens when we consolidate an overseas subsidiary, and that'll probably take the first session, take us up to our first break, so we'll have quite a long first session, and for the rest of the day we'll talk about financial instruments. So that is all as per my favorite accounting standard, IFRS 9. I did hint at it a little bit yesterday, hopefully got you all wet with excitement. Okay, looking forward to learning about this very exciting new standard that came into force a couple of years ago. So let's just start off by finishing up yesterday. So the last place I left you off yesterday was dealing with how to work on step acquisitions. Okay, so what happens when we have acquired a few shares in a company? What happens when we acquire a few more, and that results in a change in status? So what happens if you know so what happens if you had an ordinary trade investment and you moved up to an associate or you moved up to a subsidiary? That's where we ended up yesterday. There was a tiny bit left to do in the chapter on disclosures and cash flows. Now, remember that this is an open book exam, okay? So the workbook is incredibly dense. It has a lot of reference material there for you to refer back to. So with regards to disclosures, just read at home. You see this little icon here, this little house? That means it's home study. It also means have an awareness that it's there in your open book. Okay. If it comes up in the exam, there's no sort of rocket science behind it. Just go back. Just go back to the workbook, find the correct page, and copy out the relevant sections. Okay, so the disclosures are for home study, and so is the consolidated cash flows. You'll be pleased to know there is no change, so there's nothing new to learn for consolidated statements of cash flow, and you've never had to prepare one from scratch. Okay, they've already examined it. They've already examined it in FAR, so there's no point checking it again for CR. Audit and assurance implications of group accounting. So this was, you'll find that at the end of nearly all the chapters for corporate reporting, you will have a section on the audit and assurance implications. Okay? Remember that corporate reporting is 30 to 40% testing your audit and assurance knowledge. One of the most common requirements, and I'll just write it here, a very common exam requirement is to identify and explain audit risks and audit procedures. A common exam requirement is to identify and explain audit risks and audit procedures. This is similar to what you would have seen back in audit and assurance at the professional level. And quite often, you know, an exam requirement will first of all ask you to explain the financial reporting technique and then go on to talk about the audit risks and procedures. So at the end of each chapter, you have a very nice table showing the very broad generic risks and generic audit tests that could be applied to given situations. For example, in the context of group accounting, an audit risk might be the use of another auditor. Okay, so maybe you have, wrong pen. So here you've got the parent, here you've got the subsidiary. It may be the case that the subsidiary is audited by a component auditor. The subsidiary may be audited by a component auditor. So that's a different one to the auditor working on the main group. Well, in that case, one of the main audit risks would be that you are relying on the work of another expert when you consolidate the underlying balances of the subsidiary. Okay, so that would be an audit risk. Okay, it's, we're not sure on the reliability of that evidence. We haven't gathered it ourselves. We haven't drawn the conclusions ourselves. So you have some suitable audit tests on the right-hand side. You need to assess the competence of that component auditor. You need to have clear instructions, review their work, make sure it satisfies the scope of your audit, okay, and so on and so on. So that's just one example. You've got a nice list here. As I said, it is an open book exam, so these materials are there for your reference. Okay? Always have them tabbed up. One option, you may want to get them all together and keep them in one separate subsection of your folder, or maybe keep them at the end of each workbook chapter, however you wish to organize your exam file. One thing when it comes to audit risks and procedures, the examiner does not like it when students blindly copy a shopping list of audit procedures from a question they had done in the past. So the examiner does try to make each question a little bit different, and you need to demonstrate you're using details from the question to help formulate your audit tests. In other words, make your tests applicable to the scenario, even if that means just putting in the name of your audit client, okay, or mentioning some event that occurred in the scenario. Make it clear to the examiner you're thinking about the particular question at hand and you are not blindly copying a list of audit tests you saw from a previous question. Okay? So I just wanted to highlight that there. Okay, you've got the audit assurance implications of group accounting. Make sure you have them tabbed up for each and every section of your workbook. Okay. So that was all I wanted to cover in terms of the groups and updates. Okay, so let's knock that off the list. So the focus of the rest of the day then is Chapter 3 and Chapter 4. We're going to knock off Chapter 3 in the next session, I hope, and then leave the rest of the day for my favorite, IFRS 9. Ooh, gosh, I'm in the wrong section. Okie doke. So, reporting on overseas transactions. This is brand new for corporate reporting, and it's quite popular with the examiner. Okay, she does like overseas consolidation. So what we're going to do in this chapter is go through how to deal with foreign exchange transactions in the individual financial statements and in the group financial statements. Now, to explain in a nutshell, we will be focusing on group financial statements. And the problem arises where you have a parent entity whose reporting currency is perhaps US dollar. That parent owns a subsidiary in another country, and that subsidiary's reporting currency is pounds. Okay? So in the individual financial statements, one reports in dollars, one reports in pounds. There's no problem. But on consolidation, when we're consolidating the results of the subsidiary with the parent, that's where we have a problem because they're not reporting in the same currency. And so what we're going to learn in this chapter are the mechanics for translating the results of the subsidiary into the parent. That's the bulk of today, but for the minute, let's just talk a little bit about some definitions and how to deal with individual financial statements. So the relevant standard here is IAS 21, the effects of foreign exchange. So this standard is relevant for companies that transact in overseas. Okay? So if you are a retailer in the UK, it may be you have a lot of imports from the United States, from Europe. You therefore may have a lot of purchases in euros. You may have a lot of purchases in dollars. So the question is, how do we record those overseas transactions in our reporting currency? Okay. Or it could be you have loads of sales that you make overseas, either which way. So the scope of IAS 21 is, amongst other things, accounting for transactions and balances in foreign currencies. In other words, you buy or sell goods overseas. Buy or sell goods overseas. The standard also deals with translating the results and financial position of foreign operations. In other words, consolidating an overseas subsidiary. Okay. So those are the two main parts. Those are the two main areas of focus when it comes to the standard. There's a little bit at the bottom on translating the entity's results into a presentational currency. Okay, that's nothing really to be concerned with or bothered for corporate reporting. If we go on to the next page, let's learn a few definitions. So there are 4 different exchange rates you have to know. Okay, you have to understand the meaning of. So first of all, we have the historic rate, sometimes known as the spot rate. The historic rate, sometimes known as the spot rate, is the rate in place at the date a transaction takes place. So if I bought some goods overseas on the 14th of March, the historic rate will be the exchange rate on the 14th of March. Whatever rate prevailed at the date of the transaction. We then have your closing rate, which is the rate as at the reporting date. Okay, so in other words, at the year end. So it's as at the date of your statement of financial position. That's your closing rate. The opening rate is the rate at the start of the year, at the opening reporting date. Okay, think of that as at the brought forward date. Okay, so the 1st of January or whatever the start of your accounting period was. We have the average rate, which is going to be simply the average exchange rate throughout the whole accounting period, from the 1st of January to the 31st of December. And this average rate is generally used for the statement of profit or loss. It would be impractical to translate all of the transactions that occurred in the P&L at their respective historic rates. So we just use an average. Okay, it makes life easier. A little bit more on definitions, and this is revision from FAR. You need to understand the difference between a monetary and a non-monetary item. So when we talk about monetary assets and monetary liabilities, these are items that are readily convertible to cash. Okay, these are items that are readily convertible to cash. Examples are going to be your receivables, payables, or loans. Okay, they are all readily convertible to cash because you're going to receive the money soon, or you have to pay off your obligation soon. If we contrast that with non-monetary items, these are items that give no right to delivering or receiving cash. Your common examples are inventory and PPE. Okay. Now, some people ask, why is inventory a non-monetary item? Because surely you can sell the inventory. Well, yes, that's true, but when it sits as inventory on your balance sheet, it means you haven't found a buyer yet, and you may not be able to find a buyer, in which case you're not going to get any cash for it. So we've got monetary assets and liabilities. We've got non-monetary items as well. We then have to think about the different relevant currencies. So we'll start at the bottom because that's easier to explain. Your presentational currency is the currency in which the financial statements are presented. Okay? And the standard, so IAS 21, allows any currency to be the presentational currency. So I could be a company reporting in the UK, but if I wanted, I could report in dollars, I could report in Tanzanian shilling, I can report in whatever I want. Okay, that's just the currency an entity chooses to present its financial statements in. Okay, and it's very obvious what a company's presentational currency is because all you have to do is open the financial statements and you can see. The functional currency of an entity is a little bit more difficult to determine. So the functional currency is the currency of the primary economic environment in which that entity operates. And this is judgmental. It is not always obvious what the functional currency of a company is. So in the exam, there may be 1 mark for discussion of what the functional currency of an entity is. Okay, 1 mark for discussion. So how do we know the functional currency of a company? Well, as I said, it's not obvious. We need to look for indicators. The standard gives us both primary and secondary indicators. So our first port of call is to consider the currency of its sales and costs. So essentially you are asking, what is the currency in which the company makes most of its sales or incurs most of its costs? That's your first indicator, and you'll have to make a judgment based on the weight of the sales and the costs if they happen to be in different currencies. So that's your primary indicator. What is the currency of the sales? What is the currency of the costs? If it is not conclusive what an entity's functional currency is based on the sales and the costs, you may then look at secondary indicators. Okay. So you're going to look at the currency in which the company receives its funds for financing activities. Okay. When we talk about the funds for financing activities, we're talking about the currency of its loans and share issues. Okay. So how has it been funded by the shareholders? How has it been funded by the debt holders? So as I said, it's not a big deal in the exam, okay? Maybe a mark for the discussion. Hopefully the examiner will give you enough hints so that most candidates go down the same route and identify the appropriate functional currency. There are more indicators listed below. So I'm just going to put, read these at home. First read them at home so you understand them, and then have a really good reference system, maybe tab it up, FX rules on functional currency, so you know where it is if you needed to find it. There's not much more to say around that. Okay, so we're going to start off by looking at individual companies and how we deal with translating any transactions that have occurred in foreign currency. I'm going to write up my own notes. So you can do it on the previous page because there's a blank space. Let me close off my camera and we can have a go at making the notes. So what we're doing here is translating overseas transactions in individual financial statements. So initially, we translate the transaction using the spot rate. So whatever the purchase was, whatever the sale was, translated using the spot rate at that date. The subsequent treatment actually depends on if the item was a monetary item or a non-monetary item. Okay, so we're going to break this down into two sections. We'll first consider monetary items. Remember, these are receivables, payables, interest-bearing loans, and cash. So with monetary items, if they are settled by the year end, that means that the item that the receivable has been, the cash for the receivable has been received, or you have settled your amounts on the payable. So if they are settled, then we translate at the spot rate of settlement any gain or loss goes to the statement of profit or loss. So any gain or loss on settlement is taken as income or expense in the statement of profit or loss. If the item is unsettled, and that is to say at year end the receivable is still outstanding, the payable is still outstanding, then we translate using the closing rate. Any gains or losses go to the P&L. Some of you may remember this from back in FAR because this section is revision. We have seen it before in the professional level. What we haven't seen before is how to deal with non-monetary items. So remember, when we talk about non-monetary items, we're really talking about PPE. Okay? And the treatment subsequently depends on how we measure that PPE. Our two options are the cost model and the revaluation model. Now, under the cost model, it's easy because once you have translated it at the historic rate, that's it. There is no further adjustment required. With the revaluation model, we have to retranslate the asset every time a new fair value is established, and any gains or losses go in the same place as the fair value movement. So whilst you're writing that down, let's just think about it here. Remember that under the revaluation model, usually we take gains into the revaluation surplus via other comprehensive income. So if we had a foreign exchange gain or loss on the date of a revaluation gain, that FX gain or loss would also go into other comprehensive income. But do remember that also under the revaluation model, we could suffer impairments which end up going to the statement of profit or loss. And in that case, any FX element also goes to the statement of profit or loss. That's why the rules are quite generic. Well, not generic, but the rules say we follow the fair value movement. It could be P&L, or it could be other comprehensive income. Okay, so moving along then, let's scroll forward to illustration 1, please. Okay, I'd like us to talk through this illustration. So here we've got an example of a non-monetary item. Verity purchased land in the United States 5 years ago for $600,000 when the exchange rate was $2 to the pound. Wow, imagine that, $2 to the pound. I can't imagine how weak the pound is now. So, of course, this equates to £300,000. Okay. In the current accounting period, the land is revalued to the market value of £900,000, and the exchange rate is $1.08 to the pound. Land has not been revalued previously, which means there's no balance sitting in the surplus. To get the fair value in pounds, we compare the carrying value of the land at the historic rate with the market value of the land at the current rate. So we know that the land had originally cost us £300,000. The land has now been revalued to $900,000, so we have a market movement. We have a gain of $300,000 in terms of the market. However, we have a foreign exchange loss because we can see the pound has got weaker. Okay, £1 now gets you fewer dollars. It only gets you $1.80, whereas in the past, £1 used to get you $2. So we've got a gain on the fair value movement, but we've got a loss on the foreign exchange. The great thing is we don't need to split out the movement. We don't need to split out the movement between what relates to the market gain and what relates to foreign exchange. We just lump it all together. So you can see the difference is 200,000. We were carrying the building at 300. We've now got the building at 500,000, and we treat this as a normal upwards revaluation. So we're going to debit the non-current asset, credit the revaluation reserve. This is nice for you. Okay? This makes life a lot easier for you. So let's just clarify in the notes. There is no need to split out the gain between market movements and foreign exchange. Big smiley face. Okay, that's the examiner being kind. They're not always kind, but she is kind in this sense. Okay. Moving along, test your understanding 1 is a nice test your understanding. It's not the trickiest. So it's not the trickiest, so I'm going to set that for homework. Oh, I've just managed to lose my page. I'm just going to go back to the notes to make sure everyone can see. Okie doke. So as I said, the next test your understanding, please do it for homework. Okay. Just a little bit of a note at the bottom on inventory. Okay, where we're valuing inventory, remember that IAS 2 on inventories tells us it must be held at the lower of cost and the net realizable value. So if we are using cost, then cost is measured or translated using the historic rate. But if you have determined a new net realizable value as at the year end, that net realizable value is translated using the closing rate. Okay. Similar idea with impairments. Where we are impairing an asset, we remember that we always compare the carrying value with the recoverable amount. When we're comparing the carrying value with the recoverable amount, the carrying value is always at the historic rate. The recoverable amount is at the closing rate. Okay. And that's great. We've now completely learned how to deal with single company transactions. So my plan for today, for this session, for today's session was to get through all of the items listed on the screen. We've knocked off foreign exchange and single company financial statements. Now we're going to focus on the main part of today, which is overseas consolidation. Okay, so this is the big stuff. And this is the situation I was talking about earlier. Okay, let's say we have the parents, and the parent reports in, we'll switch it up this time. So the parent reports in pounds, The subsidiary reports in dollars. We are going to consolidate. We are going to consolidate, but the problem is that the currencies don't agree. So what we're going to do is look at the mechanics of translation. What exchange rates do we use to translate the results of the subsidiary? We'll look at how to calculate any exchange gains and losses and also how to consolidate. Okay? So a few rules you need to learn. All assets and all liabilities are translated at the closing rate. All assets, all liabilities are translated at the closing rate, the date of the financial statements. Okay, the date of the statement of financial position. When it comes to equity, it's a little bit different. Where's my highlights here? When it comes to equity, we always translate share capital and the pre-acquisition reserves using the historic rate. We translate the share capital and prehistoric or pre-acquisition reserves using the historic rate. Notice that they've just used the term reserves here. Okay, so that relates to your retained earnings, any revaluation surplus. Okay, so retained earnings, any revaluation surplus, and any other kind of balance, any other kind of reserve you have in equity. Your post-acquisition reserves are going to be the balancing figure. Okay, and that makes sense. If you remember our accounting equation, we said that assets equals your equity plus liabilities. Okay, and as such, your assets minus your liabilities equal your equity. So if we know what our net assets balance is, okay, because we've translated both assets and liabilities at the closing rate, then we know what the total value for equity should be. The pre-acquisition reserves are translated at the historic rate, so the post-acquisition reserves will just be the balancing figure to get that equity equaling your net assets. When it comes to the statement of profit or loss, all income and all expenses are at the average rate. Okay. Now, we are going to do this question in a moment, Portsmouth and Southampton, but we're going to do the whole thing together. I will come back to it in a moment. Oh, Emma has just asked, is the average rate the monthly average? No, it is actually the yearly average. So for the accounting period or for the period you're looking at. Thank you for that question. I think everyone will be interested in that answer. Let's skip test your understanding 2 for the minute and go to exchange differences. Okay? So the reason exchange differences arise in the first place is because we are using different rates to translate different elements of the financial statements. I've just had a question from Edward. Is there a standard way of calculating the average? Well, the truth is the question will tell you what the average rate is. Okay, so just read the detail carefully. Now, why do exchange differences happen in the first place? It's because we use different exchange rates to translate different elements of the financial statements. I'll give you an example. So think about your statement of financial position. Think about accumulated depreciation. Accumulated depreciation is a balance that sits in your statement of financial position, and we know it is a cumulative balance. So accumulative depreciation at the end of the year, my accumulated depreciation carried forward is going to be, my accumulated depreciation carried forward is going to be my accumulated depreciation brought forward plus the depreciation for the year. Okay. Now, the carried forward balance is translated at the closing rate. The brought forward balance is translated at the opening rate. And therefore, the depreciation figure must be the balancing figure. Okay, the thing that makes one side of the equation equal the other. But on the statement of profit or loss, we just said all income and expenses are translated at the average rate. So when we have a depreciation expense, that is translated at the average rate. And therein lies the problem. Because the expense in the statement of profit or loss is not going to be the same as the movement between my opening and closing balances. Okay, so we can say this figure over here does not equal the depreciation above. That's why we have exchange differences in the first place. Different elements of the financial statements are translated at different rates. Now, in the exam, you may be asked to calculate the exchange difference. And how do we do that? Well, we need to use this pro forma. So we need to calculate the opening net assets of the subsidiary, translated at the closing rate and the opening rate, and compare the difference. We also translate the profit for the year at the closing rate and the average rate, and we compare the difference. The overall exchange difference is going to be here, and this exchange difference is recognized in other comprehensive income. Not only is it just recognized in other comprehensive income, but it needs to be allocated between the parent and the non-controlling interest. Now, I'm going to give you a bit of an exam tip. Technically speaking, you need to keep your foreign exchange gains and losses in a special account within equity called the translation reserve. However, if you're running out of time, which you probably will, then just bung it all into retained earnings. Okay? The examiner is quite relaxed here. Well, maybe relaxed is too strong a word, but the examiner won't mind if you just lump everything within retained earnings and just call it reserves. So technically, the FX gain or loss should be accumulated in the translation reserve, but you can put it all in retained earnings. Beautiful. Now, whilst you're jotting that down, a question for you all. A question for you all. What always arises on the consolidation of a subsidiary? Or what arises on the acquisition of a subsidiary? Oh, too quick off the mark. Thank you, Silong. It is indeed goodwill. So one thing we need to consider when we are looking at consolidation of overseas subsidiaries is how we deal with goodwill. So going over to the next page, it tells you exactly how we treat goodwill. We have a 4-step process. So step 1, we calculate goodwill in the foreign currency. In the foreign currency. So you do not translate it until you do not do any translation until you've calculated the goodwill on the sub. You are then going to translate it at the historic rate. Then translate the figure at the closing rate. Okay, so that was your historic rate. That's at your closing rate. And you compare the difference. This difference between goodwill at the historic and closing rate will be added to the parent share of the exchange differences on the net assets of the subsidiary, assuming the proportionate method is used. And this is a big thing to highlight. If the fair value method is utilized, then the foreign exchange gains and losses are allocated between the parent and the non-controlling interest. That makes sense conceptually. Remember, the fundamental difference between the proportionate method and the fair value method was that with the fair value method, we are including the non-controlling interest share of goodwill. And as such, any exchange gains and losses on goodwill should be allocated pro rata, parent and the non-controlling interest. Okay? Beautiful. So that's all I wanted to go through in the notes. We are now going to have we're now just going to do a full consolidation from start to finish. Okay, so now let me talk you through the steps for a consolidation. Just copy this down somewhere in your notes. We'll then get a clean sheet of paper and have a go at this from scratch. So step 1. Calculate the pre- and post-acquisition reserves. Step 2, translate the results of the subsidiary. Step 3, calculate any gain or loss due to foreign exchange, if required per the question. Step 4, calculate goodwill. Step 5, calculate the non-controlling interest and group retained earnings. And step 4, consolidate. Okay. So just give you a moment to jot that down. We are then going to take a look at Test Your Understanding 2, that's Portsmouth and Southampton. I'd like us to do this on the, we'll do it by hand. We'll do it by hand. Okay. So we are going to take a look at Test Your Understanding 2, the results of Portsmouth and Southampton. So Portsmouth acquired 56% of Southampton on the 30th of June for 300 million in cash. All assets of Southampton are at fair value with the exception of plant that had a fair value of 40 million in excess of book value. The plant had a remaining useful life of 5 years. There's no intragroup trading, and NCI is calculated using the proportionate method. Goodwill has been impaired by 10 million. Okay, lovely. The financial statements are as follows. So we've got two entities here, Portsmouth and Southampton. Here's the SFP, here's the P&L, and below we have been given the relevant exchange rates. Okay, this is typical of the exam. You will be given the exchange rates you need to use. And we need to translate Southampton into the presentational currency of the parent. Fine. So we have the exchange rates. We've got the information. Oh, where am I? We were also told about the acquisition and a fair value uplift. Okay, so this description in the second paragraph, that's a fair value uplift, isn't it? Okay, it's saying that we need to increase PPE by 40 million. And credit the net assets of the sub by 40 million. Okay, so that's exactly like what we've done with normal consolidation, and this is going to be in dollars. We also need to deal with the depreciation of that uplift. Okay, so we're told that the useful life is 5 years, and so we're going to take the 40 million, divide by 5 years, that will give you your annual depreciation, and then we prorate for 3 months of the year. Okay, because the acquisition took place in June, our year end is September. Okay, and that's going to give me depreciation of 2. Debit net assets of the sub. Credit PPE. So be prepared for a few normal consolidation adjustments as well as dealing with an overseas subsidiary. The examiner can't resist throwing a few sort of adjustments here and there for you. Okay. So let's follow the steps for dealing with this translation. For the minute, all we're doing is translating the sub. Now, as I said, first thing we need to do is calculate the pre- and post-acquisition reserves. Okay? We need to calculate the pre- and post-acquisition reserves. So in other words, we need to work out what were my retained earnings at the date of acquisition. Well, we should be able to work this out because from the question, we know that the subsidiary's retained earnings at the end of the year were 270. So we can do a working here. your retained earnings at the end of the year were 270. I need to work backwards to get my retained earnings at the date of acquisition. So what we can do is deduct 3 months of profit. We can see from the question that the profit made by the subsidiary, by Southampton, was 96. Okay, so we need to divide that by 24, by 3 months out of 4. We can knock off 24, and that will give you the retained earnings at acquisition of 246. Lovely. Now, that was my retained earnings at acquisition, but we did just talk about doing a fair value uplift, didn't we? Because we know that PPE had a fair value in excess of its carrying amount. So we need to account for that uplift. We said that was 40 million. So in total, my balance is going to be 286. Okay, so this is my pre-acquisition reserves. Okay, lovely. So we've got step 1 done. We have worked out the pre-acquisition reserves, 286. The difference between that and my closing reserves must be the post-acquisition movement. Okay, so next thing we're going to do is translate the results of the subsidiary. Best thing for you to do is to draw up your pro formas for the P&L and the P&L and the SFP. So I think we're going to write this out from scratch. Okay, so clean sheet of paper out. We want nice, beautiful, clean notes. Remember, this is going to be your reference tool to look back to for the real exam. I have some questions on the chat panel about the depreciation. Do we not adjust retained earnings carried forward then? Yes, absolutely we would. For the minute, all I am doing is trying to calculate the pre-acquisition reserves. I will deal with the depreciation, don't worry. Okay, I haven't forgotten, just we'll look at that very shortly. So let's start off by drawing up our consolidated P&L, sorry, our statement of profit or loss and our statement of financial position. Maybe I won't bother with the grid lines. So for the minute, all I'm doing is copying numbers copying the P&L from the question into my answer. Now, when it comes to the results for Southampton, remember that we need to prorate the results for 3 months out of 12 because the acquisition took place in June and the year end is September. So we are only consolidating 3 months worth of the results of Southampton. So we're going to have revenue of 105, that's the 420 prorated for 3 months out of 12. When it comes to cost of sales, the draft figure is going to be $60, okay, $60,000, because that is the 240 divided by 3 months out of 12. Just want to make sure everyone's happy with what I am doing. Okay, if we prorate all these results by 3 months out of 12, we're going to get 105, 60, 15, 0, and 6. Okay, so that's where I'm getting my result for Southampton's income and expenditure. Okay. Now, when it comes to the cost of sales, the draft figure is 60, but remember that we have this fair value depreciation to deal with. Okay, so they had plant with a fair value uplift of 40 million. We recognize the uplift, and subsequently, we have to deal with the fair value depreciation on the uplift. Okay? So normally we would do a big standard working too, but we have to take a few shortcuts in corporate reporting. So if you can see it very quickly, if you can deal with the adjustment very quickly, then even better. We deal with the fair value depreciation. That is going to increase cost of sales by 2. So we've got cost of sales of 62. And the remainder we can translate from the question. So some of you are asking me in the chat panel why we are putting it in cost of sales as opposed to admin expense, because the item they're talking about is plant. So it's probable that plant is used for productive purposes. So I've made the assumption that depreciation should thus go as part of cost of sales. If you put it in admin, okay, it's not the end of the world, but generally we put the depreciation on your office buildings, your land and buildings, your head office, your fixtures and fittings within admin. For productive machinery and plant, we usually put that through cost of sales. Okay. So we've got the results of our P&L. We need to translate all of these using the average rate. And the average rate is $2.4 to the pound per the question. So make sure you are dividing by 2.4 to get the pound values. In fact, I think I'm going to do this. My apologies. I'm going to do this to 1 decimal place, I think, just to make everything a little bit clearer. So we've got profit for the year translated into pounds, or I should say profit for the 3 months translated into pounds of 9.2. Once you finish jotting that down, we'll have a go at the statement of financial position. I'm not going for the presentation mark, so I'm going to abbreviate a little bit just to get my statement down on the page. Notice that when we focus on equity, we need to split out my retained earnings between the pre-acquisition retained earnings and the post-acquisition retained earnings. I am going to be more generic here and just refer to the balance as reserves, because that's a catch-all phrase for retained earnings, any kind of translation reserve, and whatever else have you. Okay. So we've got the account names on the screen. We need to insert the dollar figures and then translate them into pounds. For PPE, okay, we're of course copying across 100% of the, we are copying across the values for Southampton. So Southampton has PPE of 400 per the question. But remember the adjustments we had to make. Remember the uplift. Okay, we had a fair value uplift of 40, didn't we? That's going to increase my PPE. That uplift took place at acquisition. By the year end, I will have depreciated that uplift by 2 million, being the depreciation on the uplift, and as such, my closing value for PPE is actually going to be 438. current assets we copy across just from the question. It's 180, giving you total assets of 618. Share capital was 110. Share premium was 80. We calculated the pre-acquisition reserves as 286, didn't we? Okay, that was our working, the first working that we did. I'll come back to the post-acquisition reserves in a minute. My non-current liabilities were 28. My current liabilities were 92. And I know, because of my fundamental accounting equation, that the total equity and liabilities must be 618. Okay, that must be the case. And because this must be 618, okay, the post-acquisition reserves must be the balancing figure. Okay, I'll save you the calculation here. It's 22. You could have calculated that as the balancing figure, or you could have realized that subsequent to the year end, or subsequent to acquisition, my apologies, subsequent to acquisition, we know Southampton has made a profit of 24. Okay, that's, but we need to deduct the depreciation. Okay. Alternatively, you could have just copied that figure over here. All right, that happens to be the post-acquisition reserves. Now, we've got all of these figures here. We need to translate them using the appropriate rate. Now, we know that with assets and liabilities, they must be translated at the historic rate, which is going to be $2 to the pound. For my pre-acquisition reserves, oh my gosh, my apologies. That should be the closing rate. The closing rate. So all assets and liabilities are translated at the closing rate, whereas my share capital balances and my pre-acquisition reserves are translated at the historic rate. I believe that was 2.5 per the question. Okay, the date of acquisition. Okay, so we get our calculators out and figure out all of these balances in pounds. We get total assets of £309. Leave your post-acquisition reserves blank for the minute. We translate our liabilities. And we know that the total equity and liabilities value in pounds must be 309, because we take that same figure from total assets and transfer it to the bottom of your balance sheet. That must equal total equity and liabilities per the accounting equation. So because we know the total of our equity and liabilities, we can work out the balancing figure to be our post-acquisition reserves. Okay, and that's what that is. So rearranging my accounting equation a little bit, we know that your total equity must equal 309 minus the value for your liabilities. So that's 249. How did I calculate that? That's 309 minus 14 minus 46. And so the balancing figure to make your equity total work must be 58.6. Okay, so well done. We have just translated the results of Southampton. Give you a moment to finish jotting that down. Have a look through the answers. Let me know if there are any questions, any numbers that you're not sure where they came from. Joseph asks, how did we get the post-acquisition reserves again? Well, the movement in your reserves since acquisition is going to be any profit that the subsidiary has made since the acquisition date. That's basically the 22. Okay, so what's happened since acquisition? Well, the subsidiary's been accruing profits from June to September. The profits were 22, so that must make up the post-acquisition reserves. Okay, so moving on then. I told you the steps for a consolidation were to calculate the pre- and post-acquisition reserves. Tick. We've now translated the results of the sub. Tick. Next thing, we're going to calculate any gain or loss due to foreign exchange. Okay? And the way we do that is by setting up this working. This is how we calculate any foreign exchange on translation of the sub. Okay. So let us have a go at the next section. Okay, what is the FX gain or loss? So I'm going to do this in a clean sheet. The way we do this is to, first of all, calculate the opening net assets and translate them at both the closing and the opening rate. Let's just remind ourselves what the opening net assets of Southampton are. Well, that must comprise the share capital, which we said was 110. The share premium, which I think we said was 80. And we had the pre-acquisition reserves, which was 286. Okay. Remember, that was your retained earnings figure plus the fair value uplift of 40. So that is going to give you opening net assets of the subsidiary as 476. Beautiful. So now we've got the opening net assets, we can go about calculating the foreign exchange gain or loss using the pro forma from the question. So we take the opening net assets and translate them at the closing rate, which I believe from the question was $2 to the pound. So that is going to give you $238. We translate the same opening net assets at the opening rate, which I believe was $2.5 to the pound. So that's going to give you 190.4. So the movement is 47.6. Okay, there's been a gain on foreign exchange from the opening net assets of the subsidiary. We're not quite done here. We also have to translate profit for the year at both the closing rate and the average rate. So the closing rate, remember, was $2 to the pound. And my profit for the year, as taken from the previous exercise, remember, was 22. We retranslate at the average rate, which was 2.4. So that is going to give you 9.2. And a movement of 1.8. So in total, we can say that our foreign exchange gains and losses will be the sum of these two figures. That's 49.4. Okay. Wonderful. Now we've got this overall foreign exchange gain on translation of the sub. Remember what I said in the notes. These need to be allocated between the parent and the subsidiary. I've just got a question from Jungmin. Where did you get the 22 profit from? Well, that was from the previous question. Okay, we're still dealing with the numbers of Southampton, and we had calculated a profit after adjusting for that fair value depreciation of 22. Okay, thank you. So we need to allocate this between the parent and the subsidiary. Between the parent and the non-controlling interest. Now, we did have the P's percentage as an annoying 56%. So 56 times the 49.4 is going to give you 27.7. And the NCI is going to get the remainder. That's 44% times the 49.4. Gives you 21.7. Okay. This is all, of course, taken to OCI. By the way, the foreign exchange gain or loss on translation is 49.4. So let's just make a note of something. The FX gain, 49.4. What were the profits of Southampton in pounds? What were the profits of Southampton post-acquisition. 9.2. Thank you, Sam. Top them up, and what do you get? 58.6. I hope that number looks familiar. That 58.6 looks just like the balancing figure we saw here. So can you see this post-acquisition movement, this post-acquisition balancing figure that we've just, slotted in to make Southampton's SFP balance? Well, that 56.8 is combined, it is comprised of the foreign exchange gain element on translation, because we see the pound has got stronger, weaker, I should say, weaker, and hence we get a gain on retranslation. And we've got the profits of Southampton post-acquisition. So what we're doing here is actually breaking down that balancing figure. We're breaking down that post-acquisition figure into the FX element and the profit element. Okay? Beautiful. So if we go back to our steps, gain or loss due to FX, done. Next step, we're going to calculate goodwill. Now, just remember the steps. Step 1, 2, 3, 4, we calculate goodwill in the foreign currency, translated at the historic rate. We then retranslate goodwill at the closing rate, and that difference is an exchange gain or loss. It goes 100% to the parent if we follow the proportionate method. It goes pro rata, the parent and the non-controlling interest, if we apply the fair value method. Okay, so let's have a go at the goodwill. So I'm going to call it my standard working three, because goodwill always is your standard working three. And remember, we're doing this in dollars, okay, because we're first calculating goodwill in the original local currency. So consideration, they told you, was $300,000. We need to add the NCI share of net assets at the date of acquisition. So the NCI percentage was 44%, and my net assets as at the acquisition date, well, guess what? We just calculated it. Okay, that was 476, wasn't it? We saw it from the previous question. In case you're wondering where that came from, go back to the FX gain or loss calc. We had already calculated the opening net assets of Southampton. That was 476. So we add on 209.4, knock off 100% of the net assets at acquisition. So we get goodwill of 33.4. Now, we were told in the question that there had been a goodwill impairment. They told you in the question, if you remember, that goodwill had been impaired by 10. So just to remind you, if we go back to the question, they did say goodwill's been impaired by 10 million. So knock off the impairment, leave a bit of space. My goodwill at the year end is going to be 23.4. Lovely. Now, these are all the dollar values. What we are going to do is translate these into pounds. Okay. Now, when it comes to goodwill, at the acquisition date, we always translate it at that date of acquisition, so at the historic rate. And I believe that was 2.5, wasn't it, from the question? Any impairments are going to be an expense in the statement of profit or loss. And we already said that all income and expenditure has to be translated at the average rate. That was 2.4. Goodwill at the year end needs to be translated at the closing rate. And that's consistent with how we treat other assets. Remember, we said that all assets and liabilities are translated at the closing rate. Well, guess what? Goodwill is an asset. It should therefore also be translated at the closing rate and reflected using this rate in the SFP. So let's work out the pound values. So 33.4 divided by 2.5 will get me 13.4. 10 divided by 2.4 will get me 4.2. Goodwill at the closing rate is going to get me 11.7. But guess what? 13.4 plus 4.2 minus 4.2 does not give me 11.7. Okay? We need to insert a balancing figure. And that is going to be your foreign exchange gain or loss on goodwill. Okay. So that movement in goodwill is actually comprised of two parts. Okay? We've got a 4.2 impairment. That is going to be an expense. We'll probably take it to admin expenditure. We've got this 2.5 exchange difference. This amount needs to be taken to other comprehensive income. Now, how much of this exchange difference will be allocated to the parent? A question for you. How much of this exchange difference will be allocated to the parent? Thank you very much, Sabine. You're absolutely right. All of it will be allocated to the parent because the proportionate method is applied. So just give you a moment to finish jotting that down, and then we will get on with covering the more techie bits, get on with calculating the more techie bits. So if we go back to my steps for a consolidation, calculation of goodwill, done. Next step, let's calculate the non-controlling interest and the group retained earnings so we can do our consolidation. I'm actually going to do these side by side. Okay, so I'm going to do this kind of in conjunction. We'll do one big working, consolidating the results of Portsmouth and Southampton. Okay, so let's get a clean sheet out, really nice, really neat. We'll do the full consolidation. And we'll calculate NCI and retained earnings. Okay. So first things first, let's do the consolidated statement of profit or loss. Where are we on? Year end, 30th September. Okay. Now, make sure you're comfortable with where I am getting the numbers from. What I am doing is copying across the results of Portsmouth and Southampton. So the 360 is going to be Portsmouth's revenue. Okay. And for the results of Southampton, I am using the pound figures from when we did our translation. Okay. So for Southampton, we've got the pound figures here. And for Portsmouth, we've got the pound figures in Portsmouth's P&L. Okay? So make sure you're happy with where the figures are coming from. So Sam asks where I got 43.8 from. No worries, Sam. So these are all the translated results of Southampton. And this means we have to go back a few, test your understanding. So let's make a note on the page. So you need to look at TYU2. These are the translated results of Southampton. Flick back a few pages in your workbook. Remember, we did this whole exercise translating the results of Southampton. So after dealing with the consolidation adjustments, we translated everything at the average rate, and it's these figures that we consolidate into the group financial statements. So we're going to have these consolidated items from the P&L, these consolidated items from our statement of financial position. Okay? Got a question from G. Are all these steps going to come up as one question in the exam? Yep, probably. Okay, they're not going to break it down into nice chunks. The requirement will just say, consolidate the results of parent and sub. Okay, and there'll be loads of extra information you need to deal with. You need to understand all of the individual steps, okay, which is why we're doing this sort of bit by bit. Notice I'm not bothering with subtotals because I can't be bothered, and in the exam for corporate reporting, that presentation mark doesn't matter. Just get your numbers down on the page. Okay. So this will get you your profit for the year. But remember that we do have FX gains and losses to deal with, okay? And that is not recognized in the P&L. That is recognized in other comprehensive income. So we're going to have to make our P&L a little bit longer. Technically speaking, it's the statement of comprehensive income for the year. So we're going to add other items of other comprehensive income. That includes my exchange differences. And remember, they consisted of two parts. We had the 49.4, which was the FX gain on translation of Southampton. We also had the FX gain or loss on translation of the goodwill. Okay, so probably just write that in the notes. Exchange differences on translation of the sub and goodwill. Okay. So these are our draft figures copied from the question. We just need to think, are there any extra adjustments to deal with? So I've copied the income and expenditures for the parent and the sub. I've included the exchange differences. The other thing I must consider is going to be the impairment on the goodwill. Remember, we had calculated an impairment of 4.2. Well, an impairment is an expense, isn't it? And that goes in the statement of profit or loss. So I'm going to have to increase my distribution and admin expenses by the amount of that goodwill impairment, 4.2. So you may want to just write in red, including the goodwill impairment. And now let's toss up our totals. I get profit for the year of 65 mil. My total exchange differences, or my exchange gains, are going to be 51.9, and so my total comprehensive income, 116.9. Beautiful. Now, that's my total comprehensive income. Because this is a consolidated P&L and not all of this amount is attributable to owners of the parent, we need to do our attribution statement at the bottom, splitting out this total comprehensive income between the parent and the non-controlling interest. Okay, so let's do that below. Now, you have never seen this before, but we need to attribute both the profit and the other comprehensive income, a little bit, both the profit and the total comprehensive income separately. I've had a very good question from G. Do you need to display the parent and the sub in two columns in the exam? This is an excellent question. So in FAR, you learned that you have to do a full consolidated profit or loss pro forma, and then separately do a consolidation schedule for the columns of P and S. If you had enough time, then yes, by means, you'd have two different columns. But in the real exam, because it's so time pressured, take any shortcut you can. So what I've done is just put everything in brackets and stuff in the results of P and S. Okay, whatever you can do to save time in corporate reporting. So do you need to display P and S in two columns? No, you don't. So we can calculate the profit attributable to the non-controlling interest. That's going to be the 44% interest it has times the profits of Southampton. Remember that was 9.2, wasn't it? Okay, we'd seen that before. So that is going to give you an allocation of 4. And if everyone's not sure where that 9.2 came from, that is the subs profit after tax. We know this total must equal 119.6, and therefore the balancing figure must be the proportion attributable to owners of the parent. Oop, my apologies. We're just looking for profit for the minute. My bad. That's 65. Rafi just asked, do you recommend abbreviating financial statement line items, shortening the FS? Rob has said he would, and I agree with you completely. Okay, so wherever you can save time, do it. So we've attributed the profit to the parent and the NCI. We also need to attribute the total comprehensive income. And I am going to abbreviate here. So TCI attributable to owners of the parent and the NCI. The total comprehensive income attributable to the non-controlling interest is going to be the NCI's percentage holding multiplied by not just the profits of the subsidiary, but also the foreign exchange gain or loss. So remember where that FX gain, so remember where that 49.4 came from. Okay, that's the FX gain or loss on translation. So well, that will give me total comprehensive income allocated to the NCI of 25.8. We know that total comprehensive income is 116.9. So the balancing figure must be the total comprehensive income attributable to owners of the parent. Okay, beautiful. Hope you're all with me. Okay, we're not seeing, or we're not used to seeing this kind of attribution statement before, but this is how we would lay it out. You'd have to first allocate the profit between parent and NCI, and then the total comprehensive income between the parent and the NCI. Okie doke. Moving along. So we've done the P&L. We now need to look at the consolidated statement of financial position. So I'm going to make it abbreviated. I'm not going to bother with my subheadings for non-current assets. We'll just go straight into it. What is the goodwill? What is the other balances? And luckily, we'd already calculated goodwill, didn't we? Okay, it was 11.7. So PPE, we've got Portsmouth with 610, and Southampton we had calculated as 219. Remember that with share capital, we only include the parent share capital only. This is a consolidated statement, remember, so the FX rules are on top of our normal consolidation rules. I think that Portsmouth had share cap of 100. Notice that when it comes to my group retained earnings, I'm just calling it group reserves now, okay? So we're sort of changing up the terminology a little bit. I've called it group reserves because that is going to include both my FX gain or loss and subsequent profits since acquisition. So instead of calling it retained earnings, we'll just give it a more generic title. Okay, so just give you a moment to finish jotting that down. Okay, so all I've done is consolidate the assets and liabilities of Portsmouth and Southampton. We're nearly there. Okay, we include the capital balances of the parent only, like we normally would in a consolidation. But we've got two things left to calculate, and that is your consolidated group reserves, which combines both retained earnings and any FX gains or losses, and we need to calculate the balance attributable to the non-controlling interest. Oh, my apologies. And I know that must be the same as my total assets. So once you've got that on the board, let's have a go at calculating working 4 and working 5. So working 4 is, of course, your non-controlling interest. Well, we know how to calculate the non-controlling interest. We take the NCI percentage and multiply it by the net assets at the reporting date, or at the SFP date. Well, we know the NCI percentage is 44%. We need to multiply that by the net assets of the subsidiary at the reporting date. Well, we already have that information. Okay, we already have that information. If we go back to our translation of Southampton, okay, you can see that the net assets at the reporting date are going to be 249. Okay, we already did it in TYU2. So I'll just put TYU2. You know where that number came from. That's going to give you 109.6. So we can insert that above 109.6. Now at this point, you could probably work out group reserves by just plugging in the balancing figure. But we're going to do a bit more than that. We're going to show you in full how we actually calculate that balance. So let's set up a working 5. And we know how to calculate group reserves. We've seen it a million times from back in your FAR days. So we take 100% of the parent's retained earnings. So going back into the question, that looks like 640 for Portsmouth. We then take the parent share, so that's 56%, times the post-acquisition movement in retained earnings of the subsidiary. Well, guess what? We've already calculated that. If you go back to your translation of Portsmouth, if you go back to your translation of Southampton, the subsidiary, what is the movement in your retained earnings since acquisition except the post-acquisition reserves? We've already calculated it, haven't we? Because this number here, that is the movement in your reserves from acquisition to the reporting date. So we insert that into our retained earnings calc. 58.6, I believe it was. So that will give you 32.8. We need to think about other things that impact our group retained earnings. Well, we know that any impairments on goodwill all will also go through working 5, and we had calculated that as 4.2 from the goodwill calc. Okay, so please refer to working 3. The other thing we need to remember is the FX gain on translation of goodwill. Remember that we are applying the proportionate method, and thus all of the gain is allocated to the parent. As such, we have closing reserves of 671.1. Okay? You could have worked that out as the balancing figure in the SFP, but I'm proving it to you the longer way. Okie doke. There is a lot to take in. Okay, loads of numbers. Take a moment, just finish jotting down the answers. Let me know, or let Rob and John know if there are any numbers where you're not sure where they came from. Sam asks, would we lose any marks just showing it as a balancing figure, even if it's wrong? No, you wouldn't. Okay, in the real exam, if you've got that far, then fantastic. You're doing really well. Just bung it in as a balancing figure. Okay, because ultimately it would have to be the balancing figure to make your SFP work. Okay, beautiful. So in terms of my steps for a consolidation, okay, I've kind of done steps 5 and 6 together. We've done the NCI and group reserves, consolidated the results, boom. This is what you need to do for a full consolidation. So I hope you keep all of these exercises together, nice and neat. Have this as a reference point for the real exam, okay? So we've got a full-blown console from start to finish. That's the example you want, okay, easy at hand if you get such a question for CR. Okie doke. So that was the chunk of this chapter out of the way. Let me just talk very briefly of the other 2 points, and then we'll take a very well-deserved break. So there is a little bit left in the workbook. Oh, do you know what? I've just had a question on the chat panel, and your timing couldn't have been more perfect, Josh. So you have asked, would you mind explaining again how we would allocate goodwill exchange differences if the fair value method is applied? Well, my answer to you is to read illustration 2. Okay? We've got almost the exact same numbers, but this time, because we're applying the fair value method, you can see that when we get to allocating any gain or loss on goodwill, we see some of it is being allocated to the non-controlling interest. So just have a look at illustration 2, please, Josh, and that will explain everything. Have it as a reference point. Make sure it's tabbed up. So illustration 2, important, so I'm going to put it in an asterisk. Read at home. Beautiful. TYU 5, lovely exercise for you to put everything in together and have a go yourself. So have a go at that for homework. Statement of cash flows and foreign exchange. Well, when it comes to the statement of cash flows, remember that your statement of cash flows can only ever reflect cash that has moved or changed hands. Any kind of foreign exchange gain or element does not appear in the cash flow. So this cash flow standard says any cash flows associated with foreign currency transactions are recorded at the exchange rate on the date of the cash flow. So if the company paid $200,000 at the end of the year and the exchange rate was $2 to 1, then the pound value is going to be £100. Okay? Beautiful. They've given a nice illustration here to tell you about how to deal with consolidated cash flow issues. So don't bother reading all the text. Let me explain to you what is happening. We have payables brought forward of 250,000 and carried forward of 166. Now, I know you all, no one particularly likes T accounts. Don't worry, they don't feature that much in CR, but I just like to illustrate this point using a T account. So my opening value for the payables, 250,000. My closing value, 166,667. Okay, so there has been a fall in payables during the year, which suggests that you have paid off some of your suppliers. However, we are told that not all of this movement relates to cash. Some of it actually relates to a foreign exchange gain or loss. And they mention that in the question. They say the exchange loss relating to payables was 21,930. If I have an exchange loss, will that make my payable get bigger or smaller? If I have an exchange loss, oh, you're too quick off the mark, Sabine. Yes, you are right. It will make my payable bigger. So FX loss, what did we say? That was 21,930. If we then balance off your T accounts, you're going to end up with the balancing figure on the left-hand side, and that must represent any cash payments. Okay, so you balance those T accounts, you're going to end up with 105,263. That's the cash movement. That's the actual cash that was paid. That is the figure which would appear in your statement of cash flows. That's as far as I'm going to go here. Okay, you won't be asked, well, we haven't yet seen a question where you've been asked to prepare cash flow from scratch. So that's as far as we need to go with the notes. Hyperinflationary economies, read at home. Okay, it's got the house icon here, so it is for home reading. Audit and assurance, very important, but there is going to be a whole module on audit and assurance as part of your SML, so you can also read that at home. Okay, I think everyone is tired. Some of you haven't had breakfast, so let's take a break now. I'm going to give quite a long break. I'm going to give until 11:30, because then we're basically going to carry on until lunch after the break. Okay? So I'm going to give a slightly longer than normal break, because we're then going to carry on all the way to 1 o'clock. Oh, just had a question on the T account. Let's go back to the T account. So Sabina asks, why are we adding the FX loss to the cash outflow? So if we think about what's happening here, when you suffered a foreign exchange gain or loss, remember what we're doing is debiting the P&L the FX loss, okay, because it's an expense in the P&L. And that is going to increase the value of your payables, isn't it? Okay, so it's a credit to the payables, an expense in the P&L. Subsequently, any other movement in the payables account must relate to any cash outflows, okay, any actual cash payments. Okay, it is 11:30, so let us reconvene for the next session of today. So hopefully everyone's had a cup of tea, stood up, had a big stretch, stuck their heads out the window. We're going to make a push towards lunchtime, so we are definitely going to break the back of Chapter 4. Quite a large chapter, quite a lot to cover here, all on financial instruments. So we finally get to meet my favorite, IFRS 9. So this chapter will take us all the way through to the end of today. What I plan on doing for the next session is to talk through the different classifications for financial instruments. You'll be happy to know that you actually know how to do one of them already. It was something you picked up back at your professional level. But you'll see that there are two other classifications we can have, particularly for financial assets. We'll go into the recognition and measurement of them. So how do we initially account and then subsequently account for them? I imagine this will probably spill over into after lunch. Now, scroll forward a little bit. We're going to go straight into section 2. Okay, so we're going to define what we mean by a financial instrument and then go on to talk about the classifications. So this definition we will have seen from back in FAR. A financial instrument is a contract that gives rise to an asset for one party and a liability or an equity instrument for another. So let's draw this out pictorially. So you could have company A to the left, company B to the right. Company A is going to be the holder or the owner of a financial asset. Okay? So that could be a receivable. It could be an investment in a loan note. It could be an investment in a bond. It could be an investment in some shares. Okay? Like we could all go out and buy some listed shares. So if we have the asset side, if company A is on the asset side, then company B must be on the other side. We say that company B is the issuer of a financial liability or of an equity instrument. Equity instrument sounds really fancy. What we mean is company B has issued shares. So either they've issued debt, or which is a financial liability, or they have issued shares. Let's look at a few examples of financial assets and liabilities. So financial assets could be cash or a right to receive cash. Okay, so a right to receive cash, interpret that to mean some kind of receivable. It could also be a contractual right to exchange financial instruments on favorable terms. Quite a long sort of mouthful. Okay, quite a big mouthful there of a definition. What we're talking about with a contractual right to exchange instruments on favorable terms is a derivative in the money. A derivative in the money. And this is something you should have covered back in your financial management days. We're talking forward contracts, options, swaps, all these sorts of things. They're derivative instruments. Okay? And it's a financial asset if you're in the money, which means if you exercise that option, if you settle the contract, you would make a gain. Or a financial asset is an equity instrument in another entity. In other words, we're talking about an investment in shares of another company. So these are the different types of financial assets. When we've got financial liabilities, they are a contractual obligation to deliver cash or a contractual obligation to exchange instruments on unfavorable terms Well, read that to mean a derivative out of the money. So if you settle the option, if you exercise the option, you settle the forward contract, you would make a loss. You would be out of the money. An equity instrument is a residual interest in the net assets of an entity without any contractual obligations. Okay, so it's the net assets of an entity, it's equity, we've seen it before. Okay, and in this instance, it's when an entity issues shares. Take 2 minutes. Please read the examples. In fact, you don't need 2 minutes for that. I'll give you 1 minute. Okay, I think that's long enough. I've read through it now myself. So what we have here are some very standard examples of financial instruments. So we're talking very simple things like a credit sale, a loan from the bank, or buying an investment in shares. You've come across all of these before. We have actually seen this page before from back in FAR actually. So the formal name for all of these kind of arrangements or relationships is a financial instrument. Okay, it's a contract between all of these two parties. The next section looks a little bit more in detail at the classification of certain instruments. So this is a bit of a recap. I'm going to just draw up our own notes to remind ourselves of this. Okay, so what we're doing is a recap of preference shares and convertible debt. Okay, so hopefully these terms sound familiar to you. We have seen them before. This is a revision from FAR. So preference shares are a type of share issue. We are all aware of that. There are 3 types of preference shares you need to be aware of. Okay. The first type is a redeemable preference share. So redeemable means you have the obligation to buy back these shares in the future. We have irredeemable preference shares with mandatory or cumulative dividends. If we say cumulative dividends, that's where if you didn't pay the dividend this year, it just gets compounded for next year. So it'll get compounded onto the instrument and you need to pay it in the following year. And the third type are irredeemable preference shares without the mandatory or cumulative dividends. So we've got 3 types of preference shares. You need to know what type they are because it impacts the classification of them in the statement of financial position. How do we classify redeemable preference shares? Question for you. Debt. Absolutely. Thank you, Jack. I'm going to use the technical term here, which is a financial liability. So redeemable preference shares are classified as a financial liability. Guess what? Irredeemable preference shares with mandatory or cumulative dividends also classified as a financial liability. The idea is because these dividend payments are mandatory, it creates an obligation of the entity. As such, the instrument must be classified as a liability. Substance over form. Thank you, Sabine. Okay, that is exactly what it is, the application of substance over form. Now, the classification matters not just for the statement of financial position, but also the statement of profit or loss. Any dividends or interest associated with these instruments are treated as an expense in the P&L. So we are going to debit our finance costs. And credit cash if it's been paid, or a payable if it has not been paid. So this is the servicing of finance. Okay, you've borrowed some money, you've classified it as a liability. Any costs associated with that finance are an expense. They're a finance cost in your P&L. On the other side of the coin then, we've got irredeemable shares without any mandatory dividends. Well, they're classified as equity. And any dividends are taken from retained earnings. Debit retained earnings, credit cash. You know all this, okay? This is just warming us up. This is a recap from accounting. So that's the preference shares. Sabine's got it wrapped up in one nice phrase. Substance over form. Okay, that good old accounting concept. Another bit of recap from professional level, which you do need to know quite well for corporate reporting, is how to deal with convertible debt. Can anyone tell me in 2 words how we deal with convertible debt? Equity and liability. Yep, that's 3 words, Sabine. But I'll accept split accounting. Thank you, Seong. So both of you are correct. The phrase I was looking for is split accounting. Very brief recap. So just to remind everyone what I mean by convertible debt. It means today I borrow some money and I issue some debt. I have to pay the debt holder interest over the term of the debt. But when it comes to redemption, the debt holder has a choice. The debt holder can either get the money back, in which case I have an obligation to deliver cash, or the debt holder can ask for shares, in which case I issue some shares. So either I have an obligation to deliver cash, which would be a financial liability, or I need to issue shares in my company, which of course would be equity. So what do? A liability or equity? The standards say we do some split accounting. The first thing we do is calculate the value of the financial liability. The way we do that is to calculate the present value of future cash flows of similar debt without the conversion option. Okay, so this would be the effective interest rate on what would be a pure liability issue, okay, on one that had no convertible element to it. So we calculate the present value of future cash flows. The equity element would be the difference between the proceeds received. Okay, so that's the total amount you've borrowed and the liability element you've just calculated. Okay? The equity element is the difference between how much you've borrowed and the portion you've allocated as a liability. Initially, okay, because I'm an accountant, I'm always interested in what my double entries are. Initially, we've borrowed some money, so we debit cash. We record a portion of that as a financial liability. And as I said, the balancing figure is your equity. Subsequently, we have two things to deal with. We've got the liability and we have the equity instrument. For the liability, we do something that you have seen before. We amortize it. For the equity, we do nothing. Okay, it stays in equity, the amount doesn't change, so just keep it there and don't worry about it. Okay? So, let's put our memory to the test. Okay, we've reminded ourselves of how to deal with convertible debt. I'm just going to zoom out a little bit so everyone can see the notes. And can you move to test your understanding 1, please, everybody? Okay, we'll go on to that in a moment. Please go to test your understanding 1. As soon as everyone's finished jotting down, we'll have a go at the next exercise. Okie doke. Onwards and upwards. Test your understanding 1 then deals with convertible debentures. Okay, so an entity has issued financial instruments. They have issued 10,006% convertible bonds at par value of 100. Interest is payable in arrears. The market rate for a similar debt without the conversion option is 8%. And we're told each bond can be converted into 4 shares in 2 years' time or redeemed at par. The specifics of the conversion are not important. The point is just that this is convertible debt, and therefore we do split accounting. Now, this 6% is called the coupon. Okay, it represents the cash that must be paid to service this liability. And that coupon is going to be 6% multiplied by the par value, multiplied by the number of debentures issued. Well, that's going to give me 60,000, isn't it? Okay, so that's a 60,000 cash flow associated with this instrument. And that will be for 2 years. Okay, so it's redeemable in 2 years. The 8% is the effective interest rate. And that's the one we're going to use for our discounting initially and then our amortization subsequently. So let's have a go at Test Your Understanding 1. And I hope as we do this, you will start to, it'll all start coming back to you. It'll be like a trip down memory lane. The first thing we do is calculate the present value of the future cash flows. Now, this is going to involve setting up a discount table. a present value calculation. Okay, so you may remember these a little bit from FAR. What we need to consider are all of the different cash flows in all of the different years. So we've got 2 years associated with this instrument. We've got annual cash flows of 60,000, and that's based on the 6% coupon. We need to multiply that by the relevant discount factor using a discount rate of 8%, and that will give you the present value. Okay, so we've got 2 years associated with this instrument. The cash flow will be 60,000 in year 1. It's going to be 1,060,000 in year 2. Okay. Remember, that is the coupon plus the redemption value if they go for the cash option. So don't forget that redemption figure. Your discount factors are going to be calculated as 1 divided by 1 plus the discount rate raised to the number of years in the future. So my discount rate is 8%. I therefore take 1 divided by 1.8 to the power 1. That's a bit redundant, but I'll put it there anyway. Multiply across. We get a present value of 55,556. And we work out the discount factor for the next year. 1 plus the discount rate raised to the power 2. Multiply across, you should get 908,779. So your total liability component is going to be 964, if we sum these up, 964,335. Initially, therefore, we debit cash the total proceeds received. I'm missing a 0 there. We credit our financial liability, the present value we've just calculated. And the balancing figure must be the portion that I insert into equity. In this case, 35665. Okay. So that's the initial treatment. We don't do anything with the equity, but we subsequently amortize the liability. So what we need to do is set up an amortization table. If you remember this skill from FAR, then fantastic. Just had a question on decimal places from Luke. So everyone always asks about decimal places. Do what seems sensible. I think 1 decimal place works, 1 or 2, but in the end, you're never going to be penalized, for rounding. So do what feels sensible to you. Subsequently, we need to consider our amortization. We look at the period, we look at the current year. We insert the brought forward value. We accrue interest at the effective rate, so that's going to be your 8%. We knock off any cash coupons, and that will give you the closing value for your liability. So we're in the year end 2003. We initially recognized the liability at 964,335. So unwind that by 8%. Knock off the payment, 60,000, and your closing value is going to be, if I just plug that into my calculator, I get 981482. Et voila. Make sure that you are always happy with the double entries. So when we are accruing interest at the 8%, that is, of course, a debit to my finance costs and a credit to the liability. It compounds on the liability, which means we add it on and it gets bigger. Every time there is a cash payment, okay, that is going to be a reduction in the liability. The idea is that you're settling some of the money you owe. So the cash payment will be a debit to the liability and a credit to cash. Look. Beautiful. Hope this is all coming back to you. Okay, we have seen this treatment in the past with financial instruments in FAR. Okay, it could very well be in CR. You're asked to do the calculations and explain the financial reporting treatment. So remember, we always think about the initial and then the subsequent treatment. Do your calcs, do your journals, explain everything in nice, concise English. Okay, moving on. Treasury shares are also recaps. So treasury shares are where a company reacquires their own shares. It is basically an alternative to a dividend payment. There's not much to say here really on treasury shares, except that when we account for treasury shares, the double entry is always to debit treasury shares, credit cash, and this sits as a negative balance within equity. It sits as a negative balance within equity. So if this were an extract of my SFP, we would have share capital, share premium, you'd have a line for treasury shares, notice that is a negative value, okay? So it's going to be the opposite sign to all the other balances. Okay, lovely. The only thing that's new for FAR is that if the company buys back some shares and then subsequently reissues them at a later date, the difference between the carrying amount of the equity reserve and the cash received is recorded in equity. So they may receive less than the balance in the equity reserve, they may receive more, and depending on that, you're going to have a debit or credit. So we just bung it into equity. For the exam, you could put it into retained earnings. Okay. And that's all there is to say on treasury shares. So onwards and upwards. Let's get on to the good stuff, the new stuff for corporate reporting. And this is all about your classification of financial instruments. So in the beginning, we are going to work on classifications of financial assets. There are 3 types that you need to know about. And those 3 types are, or 3 classifications, I should say, fair value through profit or loss, financial assets at fair value through other comprehensive income, and financial assets held at amortized cost. Now, you know this already from FAR. Okay, what we've been doing previously, where we amortize an instrument, accruing interest, knocking off the cash, that's the amortized cost treatment. Okay? Now, what we're going to do first is learn about how to classify an asset, a financial asset, into one of these categories. In the exam, you may be asked to discuss the classification. And there may be a couple of marks going for that, okay? So they tell you that an entity has acquired a bond. They tell you that an entity has bought some shares. You need to decide, oh, well, what should be the classification based on the case facts. Okay. So let's go over to the next page. We're going to split out the classifications into, first of all, examining investments in equity, and then examining investments in debt. Remember, if we go back to our definition of financial assets, we said it includes a right to receive cash. Okay, so a right to receive cash means you are owed money by someone else. Okay, you are the debt holder. Okay, it could be an ordinary receivable, or it could be that you have acquired a bond, a loan note, a debenture. In that case, you are the holder of a debt instrument. Okay, so that's one type of financial asset. The other type is an investment in shares of another company. So we're going to look in a lot more detail at how to deal with investments in debt and investments in equity. Where it comes to investments in equity, the default position is to classify instruments as fair value through profit or loss. Okay, so that's the default. We assume all equity is classified into this category. However, there is an alternative possibility. If the equity instruments are not held for short-term trading and an irrevocable designation is made, the equity instruments could be classified as fair value through other comprehensive income. However, because it is an irrevocable designation, it means you cannot reclassify or change your mind later. That is the meaning behind the word irrevocable. So you can't change your mind. Okay, you can't go back on that decision. So automatically, equity instruments are fair value through profit or loss, but we can make an election to go for the fair value through OCI option. Okay. A little bit easier to remember, I think. Okay, with equity, we've just got the two options, the two fair value options. Now let's look at classifications in debt. Okay. So when we talk about debt, this is where you have acquired, this is where you are the holder, shall we say. Oops, let's write my notes there. Let's say you are the holder of a loan note, or a debenture, or a bond, or redeemable preference shares. Okay, if you happen to be the one that owns all of these instruments, you are the one with the financial asset. Okay? And because these items are a kind of debt, it means we actually have three options for classification. That's the amortized cost, fair value OCI, and fair value P&L. Now, it all depends on two tests. So you do have some notes in your workbook, but I'm just going to summarize them all quite briefly into the space below. So where we've got investments in debt, the classification is based on two tests. So first thing you're going to do is ask, are the cash flows, are the contractual cash flows solely payments of principal and interest, which I am going to abbreviate to SPPI. So first thing you're going to ask, are the contractual cash flows associated with this instrument solely payments of principal and interest? If the answer is no, then the classification is automatically fair value through profit or loss. If the answer is yes, then you see below. The second thing you are going to ask is, what is the business model of holding such assets? So why did the company buy them in the first place? Okay. And there are only two options available here. Please, can you give an example of these assets, Aidan asks. Absolutely. So we've got examples at the top. So loan notes, debentures, bonds, redeemable preference shares. If you were the acquirer of them, okay, if you have bought some loan notes, if you bought some bonds, then that's a financial asset because it represents your right to receive cash. And these are the kinds of instruments we tend to see in CR. What is the business model? Well, if it is to hold, to collect the contractual cash flows, then this is going to be a amortized cost instrument. Okay, so we're holding to collect contractual cash flows. I must add, we're also holding to maturity. The item would therefore be classified as amortized cost. The other possible business model is to collect contractual cash flows but also sell to achieve better returns. In that case, we classify as fair value through other comprehensive income. If the business model were anything else, then we would have to go down the fair value through profit and loss route. Okay, so you've got a little bit of a decision tree here to help you out. It is based on two tests. Okay, what do the cash flows represent, and what is the business model? Why has the entity acquired such instruments in the first place? Whilst you're jotting that down, in case anyone is curious, what on earth do we mean by solely payments of principal and interest? Well, principal is the amount outstanding on the debt, and interest, according to IFRS 9, means consideration for the time value of money and credit risk. Okay, so that's the definition of interest in this standard. Time value of money and credit risk. Edward has asked a very good question. What is a contractual cash flow that is not principal or interest? And John's given a great example. It should be convertible bonds. So the return that you get on a convertible bond, that is going to be based partly on the equity, on the option to convert, as well as the liability. Okay, so that effective interest you earn on the convertible debt, that will be not just because of the time value of money and credit risk, but it will also be impacted by the option to convert. Another example, you may invest in an instrument that gives returns which are based on another underlying factor. Okay, you may have returns that are based on inflation or the return on a particular stock index. Okay, in which case the return isn't simply interest. Okay, it's going to be based on other market factors. Okay, so this is how we deal with debt. We're going to do a little bit of an exercise in a moment to test this out. Sabine asks, would it be like a derivative, say the value of gold is the underlying? Yes, that would be a good example. So derivatives are always classified as fair value through profit or loss. Indeed, they would fail the first test, wouldn't they? You're way ahead of me in the note because you'll see the next page in the notes does talk about derivatives. So hopefully everyone has finished jotting that down. On the next page then, derivatives are classified as fair value to profit or loss. Done. Nothing. That's the only option. If you've got a derivative, fair value to profit or loss, there's no other possibility. Okay. So we've got the two tests. I call them the SPPI test and the business model test. Bearing that in mind, I want you to take a minute. I want you to do two things. Tell me what category this instrument should be classified in, and then I want you to justify why. 2 minutes. No, 1 minute. Okay, 1 minute should be sufficient. What category and justify why. I know there are some responses going ahead in the chat panel, which is fine. I still would like you to please have a go. Just jot down a few notes. Okay, I think most of you will arrive at the right classification, but the skills marks in the exam are going for your justifications. Okay, I'm going to stop you there now. So I did have a contribution to the chat panel from Sabine. Thank you for that. You are absolutely right. The category is fair value through other comprehensive income. That is the classification that we should apply to this interest-bearing financial asset. Now, most of you hopefully will have got that, but you need to justify why. So that is where we apply the two tests. So do cash flows represent solely payments of principal and interest? they tell you that Consult invests in interest-bearing financial assets that adequately compensate for credit risk and the time value of money. Well, guess what? That's the definition of interest. So I am happy that the interest-bearing asset does represent solely payments of principal and interest. Next, we look at the business model. So they tell you that it regularly holds these financial assets until maturity. Sounds like amortized cost. However, to maximize returns and to minimize costs, Consult occasionally sells the assets to invest in those with higher yields or whose duration are better for its liabilities. Don't worry about that terminology so much. Higher yield just means that you get a better return, and duration matching, that's just to do with the timing of cash flows. Okay, they want the cash flows on this asset to match the timing of the cash flows on its liabilities. So the business model is to collect contractual cash flows, but also occasionally sell. Thus, we have to go for the fair value through other comprehensive income item. So I've just got a question here from Rafi about SPPI. I think it's worth going over it again because it is important. So this SPPI test, it relates to investments in in debt. Okay. So we are asking ourselves: are the returns associated with this with this instrument purely repayments of the principal amount and interest, which is represented by is consideration for the time value of money and credit risk? So if I have invested in a loan note, then I have bought the debt of another company. And by acquiring that loan note, I give myself the right to receive the coupon payments annually. And at the end of the loan term, I'm going to get all that money back. So all that money I get back, that's going to be the principal. And I get that at the end of the loan term. As for the other cash flows I receive, the coupon, well, that amount must represent my return for lending out money in the first place, i.e. the time value of money, and any credit risk associated with lending that money. So credit risk is the risk that the issuer, the one to whom you've lent the money, is not able to pay you back. Okay, so that's what we mean by SPPI. The cash flow returns are solely the redemption amount at the end and interest. Okay, beautiful. So we've gone through the classifications. We've got 3 types: amortized cost, fair value through profit and loss, fair value through other comprehensive income. So now we're going to look at the accounting and some other bits and bobs. So when it comes to financial assets, okay, they should be recognized initially at fair value. Okay? Initially, we recognize financial assets at fair value. And normally, this is just how much you pay for it. And indeed, we're going to see in a little bit later, that's what we mean by fair value. Okay? It's the price that we pay to acquire an asset. So the fair value of an asset will be how much you pay for it. Okay? That's the amount on initial recognition. That is almost always the case, but not quite. We must consider whether the instrument needs discounting to present value, which could happen when we've got an interest-free loan. Okay? Now, even if the question says it's an interest-free loan, okay, which means there are no cash flows associated with it, there is still, it's not actually interest-free, okay? Because if you are lending money to someone, okay, if you have invested in a financial asset and you've lent out money, but you're not going to get any return on that, you're actually going to make a loss because of the time value of money. You invest £100 today, you get £100 back in 2 years' time. Well, because of the time value of money, it's gone down in value, hasn't it? It's gone down in value, and that is going to be a cost for you. That's going to be a cost for you. So what we're going to do is take that amount. Okay, we're going to calculate we're going to take the time value of money that you're basically losing and recognize that as a finance cost in the P&L. So the initial value we recognize for the asset is going to be the present value of the amount receivable. The difference between the present value and the actual proceeds you receive is going to be an expense in the statement of profit or loss. Sometimes we call it a day one loss. And the idea here is that you've lent money to someone, but you're not going to earn any interest on it. Okay, well, that's a loss to you. So we call it a day one loss. Now, most of the time, discounting will not be necessary, but it does come up every so often. Okay, there is a past exam question that has it. Okay, it's called Earth Store. Sabine has asked, why are you lending in the first place then? What kind of crazy business person would do that? It may be for the purposes of a business relationship. It may be because you are the parent entity and you are lending money to a failing subsidiary. You'd hope it's not because you're just, not very good at business. Okie doke. There is a nice before we carry on, we need to think about transaction costs. So it could be there are transaction costs associated with the acquisition of the asset. Well, the treatment of transaction costs depends on the classification. If the asset is classified as fair value through profit or loss, then the transaction costs are expensed to the P&L. We do not add the transaction costs to the initial value of the asset. In other words, debit the P&L, credit cash. Okay, we do not add it to the value of the financial asset. However, if the classification is anything other than fair value through profit or loss, we actually add the transaction cost to the initial fair value of the asset. So we debit the asset, credit, cash. Okay. Right, lovely. Let's take a look through the illustration. Is there something wrong with the sound, John? You said it's echoey in here. Okay. Sorry, I was wondering. I can hear loads of traffic outside, so I was hoping it wasn't feeding in through the headphones. Nope, John's just abusing Rob. My TAs are having a battle. Oh, anything to keep them entertained, I guess. You need to start posing them some harder questions, class, so they stop going at each other. All right, let's take a look at illustration 2. So here we are discounting cash flows on a loan that has been issued at below the market rate. So Deadpool lends £1 million to a key supplier in order to help them through a period of financial difficulty. Okay, so there you go, Sabine. That's one possibility why someone would issue a loan interest-free. The terms of a loan are that an annual payment of £30,000 is made, equivalent to a 3% coupon. It's made in arrears, followed by repayment of the initial capital at the end of 3 years. Colossus would normally borrow at a market rate of 8%. So can you see what's happening here? Deadpool, the lender, Deadpool is the lender, Deadpool is the one with the financial asset. Deadpool is lending money for a return of 3%. Anyone else would earn a return of 8%. Okay? So can you see the loan has been issued at less than market rate? This is going to mean Deadpool suffers a cost, okay, because it's getting less than everyone else. Well, let's go through the illustration. So the classification of the investment, well, this is an investment in debt. It would be expected that Deadpool holds this to maturity, and the cash flows represent the repayment of capital and interest. As such, the classification is amortized cost, consistent with what we've seen before. As the investment is paying a return of less than the market rate, the initial fair value must be determined by discounting the cash flows using the market rate of 8%. So the future cash flows associated with this loan are the annual coupon of 30,000 plus the 1 million capital repayment at the end of year 3. We discount all of these cash flows using the discount rate of 8%. So we get the present value of the loan, which is going to be the fair value of the loan, as 871,000. Okay, so that's the fair value. That's the amount by which we recognize the asset. However, we've actually doled out £1 million. So that debit is going to be your day one loss. That's the hit you are going to take. Oh, absolutely. It's like you read my mind, Mark. You take the hit up front for the loss on the interest. Okay, you take the hit up front because you are not going to get a return as good as everyone else out in the market. Good old prudence requires us to do so. Being right on it, it is indeed the idea of prudence. Okie doke. Let's think about the subsequent treatment. Okay, so we love this initially subsequent sort of approach. Subsequently, we then have to amortize this instrument. So our initial amount was the 871. We accrue interest at the 8%. Okay, make sure you're happy with all of the double entries here. We're debiting a finance cost 69. We're debiting the financial asset as the asset's getting bigger by 69,692. We credit investment income 69,692. Okay, because this is the asset side. And when the cash payment is received, that is going to be a debit to cash, the 30,000, a credit to the financial asset. Okay, wonderful. So here we have dealt with the initial accounting treatment. Okay, the rules say that generally we account for financial assets at fair value. That usually means the price you've paid for them. There is one exception, which is when loans are advanced at below the market rate, in which case the fair value is the present value. Okie doke. Let's get on to the subsequent treatment. Okay, so we initially account for them at fair value. What do we do then? The subsequent treatment is determined by its categorization. For fair value through P&L and fair value through OCI assets, they are revalued to fair value at the reporting date. It's kind of given in the name. Okay, they're called fair value through P&L, fair value through OCI. So at each year end, they are restated to fair value. Everything else is held at amortized cost. Now, under the amortized cost approach, the financial asset is initially recognized at fair value, and transaction costs are added to the initial value of the asset. Okay? We recognize interest income using the effective rate. Any coupon payments are a deduction in the value of the asset. I think you guys can have a go at this. I'm going to give you 4 minutes. You don't need to explain the correct accounting treatment, but just calculate and show me the double entries. Okay, you all have a go. You'll need your scientific calculators to do this. Okay, looks like John and Rob are fighting for space again, fighting for prominence in the chat panel. I love the eagerness. Okay, we're going to take a look. We're going to take a look at Test Your Understanding 3. So, I asked you to have a go at this one yourself. Okay, so in this case, Annapolis acquired £2,100 6% bonds. Okay, so these are the terms of the instrument for $195,000. So that is the price paid. But on top of that, Annapolis has incurred broker's fees of £10,000. These are transaction costs we need to add on to the cost of the asset. The bond is redeemable at a premium, and the effective rate is 9.55%. This is going to be the rate you use to accrue your interest. Okay, and this item has been classified as amortized cost. So initially, we are going to recognize the bond at its fair value. That is going to be the $195 price paid plus any direct costs of £10,000. So initially, my double entry is to debit the financial asset, 205. Oh, is my screen frozen? I think it is frozen. Thank you, Sam. Thank you for pointing that out. So all I have done is pull the answers from the back. So if you had a look on page, I think it's 200, that's got the model answers. So initially, we're recognizing the asset at 205, which is the purchase price plus transaction costs. Subsequently, the bonds will be amortized using the effective interest rate. So you needed to set up a little amortization table. So I'm only really interested in the first row. We insert the brought forward value. We accrue interest at the 9.55%, knock off our coupon. Now, how did we calculate this coupon? Well, they've put the calculation at the bottom here. The coupons are 6% per annum, based on a £100 par value, and Annapolis acquired 2,000 of these bonds. So the annual cash flow is 12,000. Knock that off, and we get the carried forward at year end. So subsequently, when we have the interest, we are going to debit the financial asset. In fact, let me do this in thousands. We're going to debit the financial asset, 19,578, and credit investment income. I wonder how many of you recorded this as investment income as opposed to a finance cost. So in case any of you did do that, remember we are the holder of the financial asset. We are entitled to the returns on it. And as such, we make income, we make investment income on this asset. It's not a finance cost. So this recognizes the interest accrued or the interest income. And then every time a cash flow is made, we are going to debit cash and credit the financial asset. Okay. Beautiful. There is a little bit of rounding there, but don't worry so much about that. Okay. You're never going to lose marks for rounding. So beautiful. I'll give you a moment to finish jotting that down, and that will mean we've covered how to do the subsequent accounting for debt instruments classified, well, you can only have debt instruments classified as amortized cost. Moving along. Oh, I've had a good question here. So we only take into account 2004 interest and cash for subsequent treatment? Yeah, that's right. So we're only usually looking at one accounting period. So normally the examiner wants you to tell us what happens at the initial transaction date and then what happens by the end of the year. So we're looking at initial transaction, end of the year. It's very rare you'd be asked to consider more than one accounting period. Ben says, do we recognize the principal payments in 2006 elsewhere then? Do you know what you could have done? You could have easily have just written, you could have easily just written 230 there and left the balance 0. It doesn't really matter. Okay? By this point, if you've got this far, you've demonstrated that you understand how amortization works. Okay? G's asked, do we not add the final cash flow with the premium? Sabine, yes, you responded correctly. 230 has the premium on it. Remember, the premium was 15% on the nominal value. So if the nominal value is 200,000, okay, times by 115%, that's going to give you the 230. Okay, lovely. So we've looked at amortized cost. Let's carry on with the subsequent accounting treatment, but this time looking at assets classified as fair value through profit or loss. Well, the rule is, with assets classified as fair value through profit or loss, they are revalued to fair value at each reporting date. Any gains or losses go to the statement of profit or loss. So each year end, we revalue the instruments. Any gains and losses are taken to the statement of profit or loss. And we've already written it, but I want to write it again. Transaction costs are always expensed to the P&L. Okie doke. So TYU4. JK holds equity shares. So this is an investment in equity. JK holds equity shares in another company, and they are classified as fair value through profit or loss. At the date of acquisition, the investment had cost 10,000 and transaction costs were 1,000. At the reporting date, the investment is valued at 12 and it was sold soon after the reporting date for 15,000. We need to show what the accounting entries were at the date of acquisition, year end, and disposal. Okay, let's have a go at that. You can probably squeeze your answer at the bottom of the page, but I like loads of space. So I'm going to open up a brand new page for TYU4. And we've got 3 things to consider. What was the accounting entry on acquisition? So we must record at fair value and expense the transaction costs. We're going to have to debit the financial assets. I think that was 10,000. We're going to have to debit the P&L with the amount of the transaction costs. And we credit cash. Okay. Beautiful. Then we get to the reporting date. And as the standard states, at the reporting date, we revalue the asset to its fair value. Movements go to the P&L. we've got a gain in value of the asset, don't we? Because it's moved up in fair value. It's moved up in value to £12,000. So we are going to debit the financial asset, the increase, that's 2,000, and credit the P&L. So that was at the year end. Subsequent to the year end, we find out the asset was disposed. Rafi asks, what P&L account do we credit? It shouldn't really matter for the exam, just put P&L. In reality, if a company has investments classified as fair value through profit or loss, then that would be a line in and of itself. Okay, so gains and losses from assets classified as fair value through profit or loss, you may see. Okay, so at disposal, we see that the asset was sold for £15,000. Okay, so sell for $15,000. We're going to have to de-recognize the asset and record a gain or loss on disposal. So the proceeds were £15,000. That's how much we got to sell the assets. We de-recognize the financial asset at its carrying amount. We were previously holding it at $12,000. There's a difference. There's a balancing figure. Well, that's going to be a gain on disposal. We take it to the P&L. Beautiful. Lovely. Okay, so this is the subsequent treatment for assets classified as fair value through profit or loss. Revalue at each year end, movements to the P&L, on disposal, any gain or loss, take to the P&L. Okay, it does exactly what it says on the tin. What about fair value through other comprehensive income assets? Well, with these items, the assets are revalued to fair value at each reporting date, and any gains or losses are recorded as other comprehensive income in a separate reserve account within equity. Okay? So fair value through OCI, again, it's kind of given in the name. We revalue to fair value at each year end. Gains and losses go to other comprehensive income. They then get put in equity. I just call it the fair value through OCI reserve. Okay, no need to get creative here. Well, it is what it is. It gets a bit more interesting when we get to the disposal of assets classified as fair value through OCI. So on disposal, a gain or loss would be recognized based on the difference between the proceeds and the carrying amount. Okay? But the question is, where do we recognize that gain or loss on disposal? For a fair value through OCI investment in debt, we recognize any gain or loss in the P&L. For any instruments classified as equity, we recognize any gain or loss within other comprehensive income. Okay? Now, there's a reason for that. When are we ever allowed to classify equity as fair value through other comprehensive income? Do you remember from earlier in the notes? When are we allowed to classify equity as fair value through OCI? Thank you very much, Edward. You are indeed correct. It is when you have made an irrevocable election. So investments in equity are normally fair value through profit or loss, but you make a conscious decision, you make an irrevocable election to classify that instrument as fair value through OCI. So in other words, you have chosen to take all movements in that instrument via equity. It's an irrevocable election. So it would kind of almost be going back on yourselves if, when it came to disposal, you then shoved all those gains into the P&L. So it's being consistent with that irrevocable election we made earlier. Note that if the asset were an investment in the debt, we would also reclassify any balance that was previously recognized in reserves to the P&L account in the year. So in other words, with debt, we recycle any previous balance into the P&L. With equity, we do not. So that's an extra step you need to be considering. Okay, if you had a fair value through OCI reserve built up from previous years in relation to a debt instrument, and that instrument is finally sold, then all that balance sitting in equity, it gets flushed, it gets recycled into the statement of profit or loss. Okay, last push. We're going to get through Test Your Understanding 5, and then we're going to break for lunch. So you've got that to look forward to. Need a few more minutes of your love and attention, please. So we are asked to show the accounting entries for JK Co's accounts at the acquisition date, reporting date, and at the date of sale. JK holds shares in another company that are classified as fair value through other comprehensive income. At the date of investment of acquisition, it cost 10,000. Transaction costs were 1,000. Revalued to 12,000, and after the reporting date is sold for 15,000. Okay. What I'd like to do is please have a go at TYU5 in conjunction, or do it side by side with TYU4. Okay, I think it's laid out quite nicely if we do it like that. And then you can really see the difference between the two double entries. So on acquisition, let's just clarify, this is a fair value through OCI asset. Whereas the other one was fair value through P&L. So on acquisition, we record at fair value and add the transaction costs. So notice the difference. We are going to debit the financial asset, 11,000, because we're adding on the transaction costs, and we credit cash. Okay, that is on initial recognition at acquisition. Subsequently, at the reporting date, we revalue to fair value. Gains and losses go through other comprehensive income. So we know the value of the asset increased to 12,000. We're going to have a gain of 1. So we debit the financial asset 1. Credit OCI 1. Then we get to disposal, and the asset is sold for 15,000. The asset is sold for 15,000. So what we're going to do is derecognize the asset and record the gain in OCI. So what we've done is receive cash proceeds of 15,000. We derecognize the financial asset at its carrying value, and we've got a credit of 3,000. Ben has asked, does OCI sit under equity in the SFP? So other comprehensive income is that bit we add on to the bottom of your statement of profit or loss. So when you prepare your statement of comprehensive income, remember we've got items of other comprehensive income, and that's where any current year gains and losses would go. The cumulative balance sits in equity. So that's the fair value through OCI reserve, and that's the equity portion. Okay. Now, we've got a gain of 3,000. Because we have an investment in equity, that is recognized in OCI. We will also say that the previous gain of 1,000 does not get recycled to the P&L because this is an investment in equity. Beautiful. So I wanted you to do those exercises side by side so we can compare and contrast the difference between fair value P&L and fair value OCI. Okay. Sam asks, can we have an example of when OCI reserves do get recycled? I think we've got one coming up. Let's have a look. It's 1 o'clock now, so we're going to have a lunch break. We've got more exercises coming up, including investments with fair value through OCI instruments in debt. Okay, so that's when we'll see other variations. All right. Now it's 1 o'clock. I'm going to be a little bit tight on lunch and give you 50 minutes. So please come back at 1:50. Okay, that's 1:50. Okay, 1:50. So we are back after what was hopefully a nice, yummy, yummy lunch. What was on the menu today, everyone? What did you eat? Haven't eaten anything yet? Oh dear, a bit of squirrel. Okay, a bit of nice to have a bit of variety. So no more lobster. We're going on squirrel. We've got dumplings, chicken rice, spag bol, nib to M&S, sandwich. Okay, nice variety on the menu there. Surprised I haven't seen lobster yet, lobster or caviar. I had some pasta that I had left over from the other day with my ratatouille. Kai had a Sarawak laksa, which sounds incredible. Okay, so a bit jealous of that. Beats my standard tomato pasta sauce. But good to see that we are all back. Okay, so we've got 2 sessions left in which to finish off our financial instrument chapter. So we've got quite a few items left on the list. I'll hopefully get through these over the next 2 sessions. So prior to lunch, we were talking a lot about classifications, weren't we? And here we're looking particularly at the classification of financial assets. Okay, so let's go back to our workbook. Scrolling back a few pages then, just to remind you, when it comes to financial assets, we have 3 categories that you need to consider: fair value through profit or loss, fair value other comprehensive income, and amortized cost. Okay? Now, we talked about what we need, what characteristics these instruments must have in order to be classified into any of these categories. I believe the last exercise we did was TYU 5 and TYU 4. So these were looking at the accounting treatments for investments in equity. Okay, so remember that when it comes to investments in equity, there are only 2 possible classifications. They are usually automatically classified as fair value through profit or loss. That is the default assumption. And as such, on initial recognition, we record the asset at its fair value. That's the purchase price. Any transaction costs go to the P&L. Subsequently, we revalue the asset to fair value. Gains and losses go to the P&L. At disposal, we derecognize the asset. Any gains or losses go to the P&L. The other classification option for investments in equity are fair value through other comprehensive income. Remember that this classification is only available if the entity makes an irrevocable designation, okay, which means they choose to classify the equity instrument as fair value OCI, and you cannot change your mind. Okay, you stick with it, that's that. So on acquisition, we initially recognize at fair value, but we add the transaction costs. So the initial amount is going to be higher. Subsequently, we revalue the asset to fair value. Gains and losses get recognized through other comprehensive income into a fair value through OCI reserve. At disposal, the asset is derecognized, but this time the gains and losses still go through OCI. Any previous gains stay in equity. So the key takeaway, well, two takeaways, but the main takeaway from this exercise was that where we have investments in equity that are classified as fair value through OCI, we never see any of the gains or losses go to the P&L. Whether it's a gain or loss on revaluation or a gain or loss on disposal, everything goes via OCI into equity and it stays in equity. Okay. if we carry on through the test your understandings then, test your understanding 6 is a really nice one. Here we're looking at investments in debt classified as any of the 3 categories. Okay, so before we were looking at investment in equities, where you had acquired the shares of another company. Now we're looking at an investment in debt. And in this case, you've got Galbraith purchasing 1 million £10.5% loan notes. So the instrument is a loan note. You are the holder, so you are recognizing it as a financial asset. The issuer would be recognizing a liability. So Galbraith incurs 100,000 in direct costs. The effective interest rate is 12%, and the fair value at the 31st of December is 11.5 million. I'm going to give you a couple of minutes. Can you please tell me the double entries? So what is the debit and credit if held at amortized cost? And I'm going to give you 4 minutes. 1 minute left. 1 minute left. 9, 8, 4, 3, 2, 1. Okay, time is up. So I asked you to have a go at showing me the double entries for this particular instrument that Gale Brace has acquired, assuming it's classified as amortized cost. For assets classified as amortized cost, we initially record at fair value plus transaction costs. So that's the 10 million plus the 100,000, debit the asset, credit cash. Subsequently, we have to amortize the asset using the effective interest rate. I believe that was 12%, and knocking off any cash payments. So we saw that the loan notes came with a 5% coupon. So the annual payment is going to be 500,000. Going to zoom out as per request from the chat panel. So we can amortize the bond. Okay, you've got your opening balance. We accrue interest at the 12%, knock off the coupon, and get our carried forward value. Your double entries subsequently will be the recognition of investment income. Remember, it's a credit to the P&L. In the exam, you could write credit investment income, or you could write credit P&L. Not going to matter really. You'll still get the mark. Any coupons, any coupon receipts are going to be a debit to cash because that's money coming in and a reduction in the carrying value of the asset. Okay, so these are the double entries for amortized costs. Now, they haven't asked you to do this in the question, but I think it's quite handy to have extracts from the statement of financial position and P&L showing the impact of this asset classified as amortized cost. So I'm going to ask if you could get another sheet of paper out, or maybe right on the other side of the sheet you're currently working on. We're just going to draw out extracts of what this asset is going to look like in the financial statements. Just had a request to go back on the notes, so I will just pause for a moment here so you can take a look. Okie doke. So I asked you to get a new sheet of paper out. What we're going to do is write up a few extracts of your SFP and P&L under each classification. So first of all, we're looking at the amortized cost classification. In my statement of financial position, I will be recognizing a financial asset. it'll be held at its carrying amount of 10.81. We just calculated it. Leave some space, leave for other columns for the other two classifications. Leave a few lines below. In my statement of profit or loss, I am going to recognize investment income of 1.21. Okay. So now we've dealt with amortized cost. Okay, let's go back into the previous page and deal with the other two categories. So fair value OCI and fair value through P&L. Now, initially, similar to amortized cost, we record at fair value plus the transaction costs. Debits the financial asset, credit cash. Subsequently, and this is the bit where it gets interesting. Okay, so this is the bit where I ask you pay careful attention. Subsequently, because we have an investment in a debt instrument classified as fair value through OCI, we must amortize using the effective rate, and we must also revalue to fair value at year end. Let's look at how we lay out the table, and it's a little bit different to what we've seen before, so please pay attention closely. Got the opening value for the asset. We accrue interest at the effective rate. We knock off any cash flows associated with the item to get our carried forward value. Now that's not the end of the story, because this value would be the carried forward amount. So it would be the carrying value under the amortized cost classification. But we have classified this instrument as fair value through OCI. So come the end of the year, we actually need to revalue the asset to its fair value. Any difference between the carried forward amount and the revalued fair value is going to be a gain or a loss, and that gets taken to other comprehensive income. That number is simply going to be the balancing figure. So let's put our numbers in the table. We initially recorded the asset at 10.1. We accrue interest 1.21. We knock off the subsequent cash flow. So our carried forward is 10.81. That's exactly the same as what we saw above. So up until this point, it is exactly the same treatment as amortized cost. But we've got an extra step now because we need to revalue the asset to fair value at the year end. They mention in the question that the fair value was 11.5 million at the year end. So this figure must be 11.5. The difference of 0.69 must be the gain we recognize in other comprehensive income. So your double entries are as follows. For the interest, we increase the value of the financial asset, 1.21, and credit investment income, same as before. For the cash flows, debit cash, credit the assets. And now we have this extra double entry to deal with. Now we've got this 690,000 gain on restating the assets to fair value. And that will be recorded as an increase in the value of the asset and a gain through other comprehensive income. Just give you a moment to finish jotting that down, and then we are going to complete our extract. Okay, fill out our extract with the impact of this asset. Okay. So if we jump back to our extracts, at the end of the year, we've got an asset recognized under fair value through OCI. It will be recorded at its fair value. So that's 11.5, isn't it? That's not the only impact in the statement of financial position, because we have a gain on revaluation. So we're going to have the fair value through other comprehensive income reserve. This balance records all cumulative gains and losses on the assets. In my P&L, I have investment income of 1.21, same as before. Okay, one asset left, or one variation left to go. What is the impact if we classify the loan note as fair value through profit or loss? Just had a question from Sabine. Is the reserve just under equity? Yes, it is. Okay. You can call it reserves. You can call it fair value through OCI reserve. It sits next to retained earnings. In fact, let's just clarify it here so everyone's happy. Okay, back to the notes. Final one. How do we deal with assets classified as fair value through profit or loss? Initially, we record at fair value. Transaction costs are an expense, so they go into the P&L. We debit the financial asset 10, debit the P&L for the transaction costs, and credit cash the total amount advanced. Okay. Subsequently, we need to think about what else goes on. Because this is a debt instrument, remember that it is paying out cash. Every year, the Galbraith, the purchaser, is earning or receiving 5% of the par value of those loan notes. That 5%, the actual cash received, is going to be recognized as investment income. So with fair value to profit or loss, there's no concept of this effective interest rate. The interest is simply the coupon, okay, the cash payment. So we record investment income using the, based on the actual cash received, okay, based on the coupon. What did we say that was? 500,000. So we're going to debit cash 500,000. Thank you, Sabine. We're going to debit cash 500,000 and credit investment income. What else happened? Well, because it's fair value to profit or loss, we also need to revalue the assets to fair value. And that was 11.5, wasn't it? So we debit the financial asset. The difference between the original amount we'd recorded and the revalued amount, well, that's going to be 1.5, my revaluation gain. Okie doke. Once we've got that down on the page, let's think about the impact on the extracts. So come the year end, I am recording a financial asset at its fair value of 11.5. There's nothing sitting in reserves, so this figure will be blank. In the P&L, I will have investment income being literally the cash flow received. Okay, so that was the coupon payment of 500,000. We need to think about other items that impact the P&L for assets classified as fair value through P&L. One of them is going to be the transaction costs. We expensed that to the P&L, so we're going to see a 100,000 charge going through there. Let's put that in brackets because it's a cost. We also have a gain on revaluation. Let's call that a fair value gain, and that was the 1.5. So there are the extracts in front of you. Take a moment, observe the item, okay, observe the impact on the financial statements. It is the exact same asset with the exact same payout, but because of the classification, you can see it has quite a big difference on the impact to the overall P&L and the statement of financial position. Okay, maybe not in terms of the overall amounts, but certainly in terms of the presentation. Okie doke. Beautiful. So moving on. This is just a summary sheet for you to help you identify what classification you should what classification you should apply to the asset. So just keep this tabbed up. So tab it up for reference. It's going to be useful. It just covers in a nice nutshell everything we've discussed up until now. Okay. In terms of my plan for the day then, okay, let's get classifications off our list. I'm hoping we feel fairly okay with them because we have spent a good couple of, well, a session and a half on it. So moving on now with the rest of the chapter, the next thing we're going to consider is fair value as defined by IFRS 13. So jumping back into the notes, IFRS 13, okay, is your fair value measurement. Now, we talk quite a lot about fair value. Okay, we've been talking about it all morning when we talked about assets at fair value through P&L and assets at fair value through OCI. Okay, now fair value is such an important, such a big deal. It's a big concept, and it features in so many areas of the financial statements that we had to have an entire standard devoted to fair value. Okay, and that's IFRS 13 on fair value measurement. The first para is the definition of fair value. It's the price that would be paid or the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Okay? So in other words, how much would I get for selling this laptop pen? The general consensus, okay, and remember, fair value is something that's determined by the market, okay, it's not based on entity-specific factors, so the value of this pen isn't what I think the value of this pen should be, it is the value that, in general, I would get for selling this pen. Okay, that is what constitutes fair value. But it's a bit more than that. It has to be the amount I get to sell this pen in an orderly transaction. Tell me, in what situation might a transaction not be orderly? In what situation might a transaction not be orderly? Thank you, Luke. Thank you, Sabine. Thank you, Edward. Okay, so you've all said liquidation, fire sale. Absolutely. Okay, so we have quite exceptional circumstances. Have we even got a suggestion for COVID-19 in private? Well, you never know. Okay, the idea is in times of distress, in times where you just need to get rid of your assets really quickly, you will accept whatever price you have. So you're absolutely right. An instance in which a transaction could not be orderly is if, there was a distress situation. So we'll put here an orderly transaction is not a distressed situation. And it's within arm's length, or at arm's length, we should say, really. Thank you for your contribution, Rafi. Oh, Luke, I don't think the examiner is going to even dare go down the pandemic route. So we don't need to worry about that for the minute. Let's see what happens. Let's see what happens at the end of the year. Let's see what actually happens with companies, because I don't think it probably covers in the standard what happens in this situation. Right. So fair value is the price that would be paid to sell an asset in an orderly transaction between market participants at the measurement date. So you want your reference to a fair valuation being as close as possible to your reporting date. When we talk about market participants, we're talking about reasonably well-informed investors. reasonably well-informed investors. Okay, they don't have to be bright, shining chartered accountant stars, but they need to at least have an idea of what they're talking about. Okay? Now, the whole point of having an entire standard on fair value is to increase consistency and comparability in fair value measurement. So when an investor is looking at two different companies that hold various assets, or maybe they hold identical assets, okay, we would expect the value of those assets to be the same, okay, because fair value should mean the same thing across the market. So it's probably worth mentioning that here, actually. It is the market that determines fair value. It is not due to entity-specific factors. Okay. Now, because this measurement of fair value is quite important, and indeed it is something investors would rely upon. Okay, when investors look at the financial statements, they are told the fair value of this asset. They are told the fair value of this item. Well, in that instance, they need to be they need to be comfortable with that valuation. They need to feel like it's a reliable estimate, because at the end of the day, remember, fair value is an estimate because you're thinking about the price you would get to sell an asset. It hasn't happened yet. You may get more, you may get less. So we are basing the valuation on an estimate. What IFRS 13 does is bucket all the fair valuations of your assets into a hierarchy. So we've got three hierarchies. We've got level 1, 2, and 3. Whether the level at which an asset is placed in the hierarchy depends on the reliability of the inputs used to determine its fair value. Level 1 is considered the most reliable. And then going down the hierarchy, level 3 has the least reliable inputs. So let's look in a bit more detail at what I mean by inputs. So if we talk about the level 1 hierarchy, we are saying that the inputs used to determine that asset's fair value is very reliable. The most reliable we can get is quoted prices in active markets, okay, for identical assets or liabilities. So just think about quoted shares. Okay. So if anyone wants to know the value of a Sainsbury's share right now, just go to the Bloomberg terminal, okay? Go to any kind of financial hub, go to, wherever they release this data. Typically a Bloomberg terminal, type in the code and you will get the quoted share price of a Sainsbury's share, okay? And that is going to be based on probably the average of all the prices in which these shares were traded over the most recent period, okay? It's a quoted share. It's recent. If it's taken place in an active market and we've had a reasonable level of volume, then we can be pretty sure that the quoted price for a Sainsbury's share is indeed the fair value of a Sainsbury's share. It's very reliable, and as such, we categorize it as level 1. But it may be the case that our investment in the financial asset is not quoted. Okay, we don't have any directly observable inputs for how to value that item. Well, in that case, we may bucket the asset in level 2 if we use inputs other than quoted prices that are included in level 1. And those inputs have to be observable for the asset or liability, either directly or indirectly. The most common example, or the best example I can think of, are proxies. Okay? So maybe you don't have a quoted price, a share price for an identical asset that you hold, but you have a quoted price for a similar asset. Let's think about, let's think about something a bit more tangible, okay? Maybe you're trying to determine the fair value of an item of PPE. Okay, that's possible. Fair value is relevant to more than just financial instruments. Maybe we're trying to value or determine the fair value of an item of property that we have. We don't have a directly observable input, but we can look at the value of a similar property which was sold recently. So maybe we can look at a similar property sold recently. All right? I don't know how much this house is worth, but I know the almost exact same house was sold on the other street for this much. It was a little bit bigger, so we'll make an adjustment for that. But otherwise, it's going to be a pretty reasonable bet. So level 2, okay, is where we categorize assets that have no directly observable input, but has indirectly observable inputs, okay, such as proxies, such as similar items. The least reliable category or the least reliable level for bucketing your assets would be in level 3. And that is where the inputs used to derive the fair value are unobservable. Okay, so the inputs are unobservable. One of the most common examples is the income approach. Okay, so the income approach, you may have heard this called discounted cash flows in the past when you did financial management. Okay, so income approach is a valuation technique that converts future cash flows of the asset to a single current discounted amount. Okay, so called the income approach. You could also see it referred to as discounted cash flows. Other possibilities are maybe price earnings multiples, okay, other valuation techniques that use unobservable inputs. Okay. All right. The next section looks at bid-ask spreads. So we've all seen these before. When we travel abroad and we want to buy some euro, we want to buy some dollars or whatever currency we need, we go to the Bureau de Change and they give us not one figure but a quote. Okay, they give us one big figure. Sorry, they give us a quote, not one figure, and that is going to be the bid-ask spread. All right? The bid-ask spread. They never give you one exchange rate, they give you two. And what does that mean? Well, the bid price is always the lower number. It is how much the dealer will pay to buy the currency off you, and as such, it is how much you would get if you sell the item. Okay, I'm using currency as an example, but you could use shares, other debt instruments as an example. So the bid price is always the lower price, and it's how much you would get if you sell the item. The ask price, I'll do this in a different color. The ask price is always the higher price, and that is how much you would have to pay to buy the item. How are you going to remember which one is which? Think of which you'd least prefer. Would you rather sell something for a lower price or a higher price? You're going to want to sell it at the higher, aren't you? But tough luck. When it comes to the bid-ask spread, you can only sell for the lower price. Okay, that is the bid price. All right. So remember our definition of fair value. It is the price you would receive to sell an asset. It is the price you would receive to sell an asset. And as such, the bid price is going to be the fair value of the asset, isn't it? Because by definition, the bid price is how much the dealer will pay to buy from you, and as such, how much you will get if you sell the asset. So the bid price is the fair value. If you acquired the asset, however, you would be paying the asking price, wouldn't you? Okay, you would pay the higher amount. Well, the difference between the bid price and the ask price is called the bid-ask spread. And that is how dealers make their money. Okay? They buy at the lower price, they sell at the higher price. That difference is the dealer's commission. It's income for them, and therefore it is a transaction cost for you. Okay? Note IFRS 13 also allows mid-market prices, so I guess the midpoint between your bid and ask. But in this example, we'll continue with the bid-ask spread. Okay, in an exam question, you just read the detail carefully. So, an entity purchases a financial asset that is classified as fair value through OCI, paying the ask price of 102 and brokerage fees of £3. At the reporting date, the entity remeasures the investment to fair value. Following data is relevant. So we've got data at the acquisition date and at the reporting date. How would the above transaction be recognized at acquisition and at the reporting date? And then, that's part one. And then two, show how the above would be recognized at acquisition and the reporting date if it were classified as fair value through profit or loss. Okie doke. So we are going to have a go at that. Let's draw this up in two columns so we can compare and contrast the difference in the double entries. Forgotten what TYU we're on. Ooh. We are on TYU 7. Okay, so for this particular asset, they have paid £105 per share, haven't they? And that 105 is going to comprise three different things. £100 is the bid price. And that, by definition, is the fair value of the share. Okay? So I'm just using numbers from the question. The bid price was 100, the ask price was 102. So they would have paid this figure, but the fair value is going to be the bid price. So that difference of £2 is the bid-ask spread. They've also paid an extra £3 in broker's commission. Okie doke. So we're going to look at the treatment, assuming fair value through OCI, and fair value through P&L. Okay, so with the fair value through other comprehensive income, remember that we capitalize, wrong word, remember that we recognize at fair value plus transaction costs. So we're going to debit the financial asset the full amount, fair value plus transaction costs, and credit cash. In the other category, we only recognize the fair value as the initial amount for the asset. Okay. Subsequently, let's think about what happens. Well, if we go back to the notes, at the year-end date, we've been given the bid-ask price again. This 110 is going to be the fair value as at year-end. Okay? It is how much they would receive if they sold the asset. So this is the amount we are going to revalue the items to. So we revalue the fair value. We determine that to be 110. We're going to debit the financial asset 5 and credit other comprehensive income 5. Under fair value through profit or loss, we debit the financial asset 10 and we credit the P&L 10. Okie doke. So now hopefully you've got all of that down on the page. Next section on fair value. Just have a read through that at home. Okay, so just telling you about when there's more than one market for determining fair value, which one we should use, and we've got a nice illustration there for you to enjoy as well. Okay, so leave that for home reading. Wanted to talk with you a little bit about the disclosures on fair value. So nothing too much to add there. You won't be asked to prepare these disclosure notes. You won't be asked to prepare these disclosure notes, but just know that where we've got assets classified as fair value, they do need to be categorized into the fair value hierarchy. What have I said? Where we've got assets that are measured at fair value, okay, they do need to be placed somewhere. They do need to be placed in the fair value hierarchy. So, for example, we may have 3 columns, level 1, level 2, level 3, and your total. And the different kind of instruments the company may have could include cash, bonds, and equities. So these are 3 kinds of financial assets. Okay, and let's say they are all measured at fair value at the year end. Well, that fair value would have been determined using inputs from the level 1, 2, 3 hierarchy. So depending on which inputs were used, okay, that would determine which level the assets are categorized in. So cash is going to be level 1. We may have bonds, some of which are classified across the levels. You may have equities, again, classified across the levels, depending on if they are quoted or not. So that's generally what the presentation looks like. Okay. Lovely. So in terms of my plan, let's knock off fair value. Okay, so I wanted to spend a bit of time on the definition and the inputs. and you've got a little bit of a note there on disclosure. So I'll just give everyone a moment to finish jotting that down before we continue with the chapter. Sorry, I've had a question from Sabine. Oh, thank you, John. You've already answered it. What is the principal market? It's the market where you have the most transactions of that particular item. Okie doke. Now, the next page is a very short section on reclassification. Okay? So once an entity has classified an asset into fair value through OCI, amortized cost, or fair value through P&L, it is very rare for the asset to be reclassified. It's possible, but it is a very rare event. Okay? And the standard says that, where the reclassification is because of a change in business model, all the assets within that group must also be reclassified. So, it's quite onerous, quite a big deal. The main bit I'm going to highlight here is that this is expected to be a very rare event. Okay, so we don't see it very often, but if we do, you have a list of rules on the next page for when an item can be reclassified from one category into another. Okay. I'm going to say tab this up, read at home, and tab up. Okay, it's not highly examinable. It's very rare, hardly comes up, but we've included the information in your workbook because it's an open book exam. Okay, and it's only a couple of pages, so know where it is. If the situation comes up, you just follow the rules in that sheet, but we don't tend to see it come up. What is a lot more relevant is impairments. Okay, so if we zoom out for a little bit, just forget about the notes. Let's think about what is happening in the real world. Okay, so you've got loads of businesses that are in a little bit of trouble. Okay, you've got restaurants, you've got airliners, you've got pubs, bars, anything in the service industry really. Okay, you have a lot of businesses that suddenly aren't making all the income they were planning on making. And as a result, they're going to have loads of issues, aren't they? Because they may not be generating any income, but they're still going to incur a lot of costs. Hey, you still have to pay your employees. You still have to pay your rent. You still have to pay the interest on any loans you have borrowed. Okay? So from the perspective of the bank, okay, from the perspective of the one who has lent out the money, what is the biggest risk they face at the minute? If I were a bank that lent out some money in this particular point in time, what is the biggest risk I face? Thank you very much to Sabine, Thurston, Rafi, and Sam. You've all said it in slightly different ways. We're worried about default. We're worried about risk. In particular, it's called credit risk. Credit risk is the risk that your borrowers won't pay you back. Okay? Other terms, we can call it a bad debt. So that's what the impairment rules of IFRS 9 talk about. Okay? This is all from the perspective of someone who has an investment in debt. Remember that an investment in debt, okay, entitles you to the right to receive cash from the issuer. If that issuer cannot pay you, if they default on the contractual obligations, then that's called a default, and the broader term for this kind of risk is credit risk. Okay? Credit risk. If we go to the definitions, along the lines of credit risk, a credit loss is determined to be the difference between the present value of the contractual cash flows and the present value of the cash flows the entity actually expects to receive. Okay? I should have highlighted this bit too, actually. So a credit loss is the difference between how much money you are owed and how much money you are actually going to receive. Okay? So I may be expecting to receive 100, but if I only get 80 back, that difference is my credit loss. Okay? It's the amount I'm never going to see again. So that amount is going to be a cost for me. Okay? And because of good old prudence, okay, remember good old prudence, she says that where we expect to incur a loss, where we expect to get a hit, whether it's from bad debt or whatever else, we need to take that hit up front. So we need to create what we call a loss allowance, okay, or an expected loss allowance. And this is something you may remember from accounting because it sounds a little bit like your allowance for bad debts, doesn't it? It's kind of similar. Okay, so you've got the gross amount receivable, but you're worried that you won't get all of it back, so we create an allowance, okay? And that way, we've taken the hit early, and we're being prudent about the value of the asset we record on the SFP. Thank you, Luke. You are correct. The expected credit losses needs to be forward-looking, so I will get onto that in a minute. And indeed, that's one of the biggest changes since we've started applying IFRS 9. So let's just get through the specifics of how we apply this standard. So the impairment rules are only relevant for debt instruments measured at amortized cost or at fair value through other comprehensive income. Okay? The impairment rules do not apply to assets classified as fair value through profit or loss because any credit losses are already captured when we remeasure the asset to fair value. So there's no problem. It's already reflected in the profit or loss. We also don't need to worry about impairment losses with equity instruments. Okay? With equity instruments, whether they're fair value through P&L or fair value through OCI. Now tell me, question for you. Why don't we suffer credit risk with equity investments? Why don't we suffer any credit risk with equity investments? I want a little bit more elaboration than that. Think about the definition of credit loss. Beautiful. Thank you very much, Edward. Okay, because there's no guaranteed cash flow, because there's no obligation. Thank you, Rafi. There is no contractual obligation for the holder of an equity instrument to get any cash flows. Okay, there is no right to receive cash. Okay, and as such, equity instruments will, we never need to worry about impairments when it comes to investments in equity. And let's just note that down. Okay, so we have no contractual cash flows associated with equity, therefore no credit risk. All right? Never, ever, ever worry about credit risk where you've got an investment in equity. You might get a dividend or you might not. Okay, it's the risk that you take as a shareholder. All right, there's no guaranteed interest. There's no guaranteed return. Okay, a few other definitions. We need to think about the expected credit losses. Okay, so expected credit losses is basically a probability-weighted estimate of the business's future credit losses. Okay, and that's the amount we're going to lose in the future because the issuer, the borrower, couldn't pay. And Luke is absolutely right in what he said. This is indeed forward-looking. So we're not just looking at all the credit losses we've incurred to date, we're looking at all the credit losses we expect to receive in the future. So we need to think about all the problems our issuers could have. We need to think about all the scenarios that could lead to our borrowers defaulting and incorporate that in determining our expected credit losses. Our credit losses are broken down into what we call lifetime expected credit losses and 12-month expected credit losses. Lifetime expected losses are how much you expect to lose over the life of that financial asset. 12-month is how much you expect to lose within the next 12 months. Okay? Rafi says, like going concern EGA, no further work required. Lovely. Lovely. Okay. Now let's get on to the accounting treatment. On initial recognition of any financial assets in debt that are classified as amortized cost or fair value through OCI, on initial recognition, we must create, or entities must create, a loss allowance based on the 12-month expected losses. And that is because prudence tells us to. So even if there's been nothing to suggest that our borrower won't repay, even if there's nothing to suggest that we've got increased credit risk, it doesn't matter. On initial recognition of the asset, we immediately recognize 12-month expected credit losses. So let's take a look at this illustration. An entity invests in a £1 million loan note measured at amortized cost. Credit risk is low. Doesn't matter, we don't care. You still have to recognize 12-month expected losses. Now there is a formula for calculating your expected losses. So we calculate it as the exposure at risk. Exposure is how much you have lent out. So in this case, the 1 million. We multiply it by the loss given default. So that is how much of the value of the asset you would lose if the borrower defaults. And we multiply it by the probability of default. Okay, so that's the formula for your expected losses. And they've done that for you in the question. Okay, our exposure is 1 million. They tell you that there is a 5% risk of default in the next 12 months. So that's your probability of default. And if the entity defaults, then 25% of the gross carrying amount will be lost. So that's your loss given default. Okay. Beautiful. So we've got a loss allowance to recognize amounting to 1,250. That is the initial accounting treatment. We, of course, need to think about the subsequent accounting treatment. So all the way over to the next page. Question from Luke. So 75% is the amount they would recover if the entity defaulted. Yes, that is correct, Luke. That may be because the loan is secured by something else. Okay, it could be collateralized, and therefore you may be able to repossess something worth 75% of the loan value. Depends on the terms. PD is your probability of default. So it's like the formula below, probability of default. And LGD is your loss given default. It's your loss given default. Use the formula below. Lovely. So that was the initial accounting treatment. The subsequent accounting treatment depends on how the credit quality of your investment has moved. Okay? So in the beginning, you may have lent money to someone who seemed pretty, pretty reliable, pretty trustworthy. Okay, maybe I had lent some money to Rob, my beautiful teaching assistant, back in the day when he seemed all, safe, trustworthy. Okay, he promised me he'd get my money back. But then some time passes. Okay, and I find out that the credit quality of my investment, of my loan to Rob, is significantly deteriorating. Okay. And that's because, Rob's got, he loves his fancy watches, okay? And he's been spending too much and he can't pay me back, all right? And I have evidence of this. So I should have asked John for a reference. You're absolutely right, Luke. Okay, why? I had to pick someone, Rob, come on. So, I initially lent some money to Rob. It seemed like a good bet, but then 1 year later, I find out he's struggling to curb his spending habits. Okay, I know that his pet dog wants nicer toys, and he's treating the dog too much, and therefore he's putting that above paying me back my money. So we can say the credit quality of my investment has significantly deteriorated because the situations around my borrower, okay, they are less likely to pay me back. Well, where there are indications, where there is a indication that the borrower, okay, is less creditworthy, okay, that they can't pay you back as much as you originally thought, well, you need to think about which stage to classify them within IFRS 9. What am I talking about with stages? Well, IFRS 9 has 3 stages in determining the credit quality of your investment in the debt. Now, stage 1 is there for financial assets whose credit quality has not significantly deteriorated since initial recognition. Okay, so that suggests nothing has changed. The situation's exactly the same. Rob is still as creditworthy as the day I originally lent the money. Well, in that case, we continue to recognize 12-month expected credit losses. Okay. However, if the credit quality had significantly deteriorated, okay, if there is indication that actually Rob can't pay me back all that he promised, then the asset is going to have to move on to stage 2, okay? And financial assets are whose credit quality, stage 2 is for assets whose credit quality have significantly deteriorated since their initial recognition. Now, this is, of course, a matter of judgment, but there is a rebuttable presumption that an asset is classified as stage 2 if it is 30 days past due. So if it has been longer than 30 days and Rob still hasn't paid me any interest, then automatically I would have to transfer his loan into stage 2. What is the implication of being a stage 2 asset? Well, it means we're going to have to recognize lifetime expected credit losses. So your loss allowance is going to get that little bit bigger, isn't it? Before we were only looking at 12 months, now we're going all the way to lifetime expected credit losses. Stage 3 is the really worst situation. Okay, that is where there is objective evidence of impairment. So that's pretty much where Rob sent me a letter and said, hey, Fasheen, I'm really sorry. There's no chance I'm going to pay you back. And in that instance, we continue to recognize lifetime expected loss allowance. Some of you may be thinking at this point, hang on, what's the difference between stage 2 and stage 3? We're still just looking at lifetime expected loss allowances, so what is the difference? Well, we're going to see in a minute when we look at some illustrations, because the classification from stage 2 to stage 3 does actually impact any subsequent interest you recognize on the asset. Now, before we continue on, let's clarify what we mean by objective evidence of impairment. Okay? Well, that is where you've got a clear indicator, something has happened out in the real world that confirms to you that, Rob cannot pay you back. Maybe there is significant financial difficulty of the issuer. Okay? Maybe there was just too much fighting going on in the chat panel. One of them had to go, so it had to be Rob. Sorry, Rob. John stays. So maybe there has been financial difficulty of the issuer. No, please don't go, Rob. I'm joking. Please stay. Oh, I'll be lost without you. All right. So maybe there's significant financial difficulty of the issuer. Maybe there is a breach of contract, so maybe the issuer has actually missed an interest payment. Okay, well, that's objective evidence, because why are they missing payments unless they can't afford to pay? Maybe the lender is granting a concession to the borrower that the lender would not otherwise consider, such as if the borrower is going through financial difficulties. Okay, so you may have heard of this phrase before. It's called forbearance. Okay, so that is where the lender is giving them, a bit of a break. Okay, so maybe you don't have to pay me anything now. Maybe you can have an interest holiday, and you'll pay me in a few months' time. For those that have been reading the news recently, in light of all this pandemic, we have been hearing a lot about borrowers being given payment holidays or interest holidays. We see that within the context of homeowners who are asking for holidays on their mortgages. We are seeing it in the form of businesses who are asking for holidays from their rent or from any other kind of loan obligations they have to their banks. Okay, so certainly when the lender is granting a concession, okay, that you're only going to be granting that if the borrower is struggling to pay you back. Other indicators, it looks like the borrower is going to end up in bankruptcy. Maybe there's a disappearance in the active market because of financial difficulties, and that means you can't get rid of the financial assets. So you can't sell it on to someone else because no one will buy it off you. They know the issuer is not good for the money. It could be that the purchase of a financial asset is at a deep discount that reflects the credit losses. So where you've bought an investment in debt for really, really, really cheap, okay, the only reason you'd buy it so cheaply is if, that's how much it was worth, okay, because the idea is you're not going to get that money back. So it's not always possible to single out a particular event, but these are indicators. In the CR exam, you need to read the text carefully, and any of these indicators would suggest looking at stage 3. Okay? All right. Now, let's think about the difference between stage 1, 2, and 3. As I said, with stage 1, we are looking at lifetime, at 12-month expected credit losses. So I'm going to write a few notes below. Okay? When it comes to stage 1, financial assets, what we are saying is the asset is not credit impaired. There has been no significant increase in credit risk. your loss allowance is going to equal 12 months expected losses. Okay, so that's the deal with stage 1. If we look at stage 2, that is where the asset is still not credit impaired, but we have a significant increase in credit risk. As such, your loss allowance is the lifetime expected losses. Okay? And that is going to be a formula that is going to be your exposure at risk multiplied by the loss given default multiplied by the probability of default. Okay? I think I should have written the same above. So the same formula applies for stage 1. We look at the exposure at risk, multiply by the loss given default, and multiply by the probability of default. So in either case, you are still calculating the loss allowance in the same way. You're using that formula. But when it comes to stage 3, that's when it gets really bad. That is where the asset is credit impaired. Where the asset is credit impaired, your loss allowance is calculated as follows. You look at the carrying value of the asset, and you compare it to the present value of the revised cash flows using the original discount rate. Take one number away from the other and you get your loss allowance. Okay. So the reason I wanted to go through that is just to compare and contrast the difference. Between stage 1 and stage 2, the difference is that we're recognizing 12-month expected losses or lifetime expected losses. The difference between stage 2 and stage 3 is that we are definitely sure the asset is credit impaired. We have objective evidence that we're not going to get back all the funds. And so we calculate the loss allowance as the difference between how much we're expecting back, which is the carrying value, and how much we think we will actually get back, discounted to present value. Okay? And when we discount, it has to be using the original discount rate when we initially recorded the asset. Okay. It is 3:15, so we're going to take a kind of break, but I'm going to give you a little bit of homework for this break. So can I ask you to read through illustration 5 and then take a break? Okay, so we'll be back at 3:30. I want you to read illustration 5 and then take a break. It's a bit of a working break, shall we say. The illustration shouldn't take you longer than 15 minutes to read. Okay, so maybe about 5 minutes on the illustration, 10-minute break, and I will see you all at 3:30. I think you'll be faster than that, Rafi. I believe in you. Wait, am I on mute? There we go. Okie doke. Welcome back, everybody. So we had a 15-minute break, but that it did involve a little bit of work. So hopefully you all don't hold that against me. Just wanted to get straight into illustration 5 with everyone being on the same page. So when we account, so just before the break, we were, of course, talking about the impairment rules under IFRS 9. So the impairment rules are only really applicable to debt instruments because, of course, it's only debt instruments that face credit risk. Okay? And with credit risk, we're worried that our borrowers may not repay us, so we need to create a loss allowance. IFRS 9 says that on initial recognition of a debt instrument classified as either amortized cost or fair value through OCI, we must initially recognize a loss allowance equivalent to 12-month expected losses. Subsequently, we need to monitor the credit risk and the credit worthiness of our borrower. Okay, and depending on whether the credit risk significantly increases or decreases, that may mean that the investment is classified from stage 1 to 2 or from 2 to 3, depending on how much our credit risk has increased. I think illustration 5 is a lovely question to look at, or a lovely illustration to look at. So you've all read it now. We've got a 4-year, £1 million loan issued at par, carries interest at 4% and is repayable at par. The effective interest rate is also 4%. Now, I see there were a few questions in the chat panel about that. I will come to that in a moment, okay? Now, initially, what has happened is that Max has acquired a loan and so should be recognizing a financial asset. We debit the asset, credit cash. We recognize it at its fair value, which is the price paid, plus transaction costs, but there weren't any in this case. And even though currently there is no increase or credit risk associated with Paddy, it doesn't matter. We still recognize a loss allowance equal to 12-month expected losses. And that is going to give you a value of 12.5 thousand. They've given you the percentages so we can calculate it. The initial double entry is to debit the P&L and credit the impairment allowance. Okay, and that's the double entry for recognizing loss allowances with investments classified as amortized cost. Note that the allowance is netted off against the asset on the SFP. So that's a little bit similar to what we saw in the past, back in your accounting days when you looked at allowances for receivables, didn't we? That was where you had the gross receivable. We netted it off against the allowance, and it was that net amount which we reflected as the balance in the statement of financial position. So that would have been the carrying value on the SFP. Okay? So that would be on initial recognition. We record the asset. We also recognize a loss allowance. We then fast forward 1 year later. And subsequently, we find that there has been a significant deterioration in the credit quality of the loan. As such, the asset moves to stage 2. The consequence of that is we recognize lifetime expected losses. So the loss allowance increases to 37.5, and as such, we're going to increase the value of the allowance by 25,000. Okay, so that's the revised loss allowance minus the loss allowance we recognized at initial recognition. Okay, now as well as that, don't forget, Max is still getting interest income from Paddy. And this is where I saw a few messages going on in the chat panel. So just want to make sure everyone's happy here with what's going on in this double entry. the asset was issued at 1 million. Okay, so that's the brought forward value. We then accrue interest at the effective interest rate, which is 4%. That is going to give you £40,000. Any coupons are recorded as a deduction in the financial assets. That was also 4%, wasn't it? So we knock off £40,000, and as such, the carried forward is 1 million. So technically speaking, the double entries are broken into two parts. First of all, we accrue the interest. So we debit the financial asset, 40,000, and credit the P&L with the investment income. Okay, we accrue the investment income, debit the asset, credit P&L. When the cash is received, that is going to be a reduction in the value of the financial asset. So we debit cash, and we credit the financial asset. So that's the full story here. In the illustration, they've just taken a little bit of a shortcut and knock, knock. I've ticked off those double entries because they cancel out really, don't they? This always happens when the effective interest rate happens to be the same as the coupon rate. It means that the carrying value of the loan is always the par value of 1 million. Okay, so that's where that double entry for debit cash, credit the profit or loss came from. It's just a kind of abbreviation of the full method I've written below. Okay, in case that was causing anyone any bit of consternation. All right, so we're now at stage 2 at the end of 2001, but we're still receiving the 40 grand. Great stuff. Let's fast forward to the next accounting period. Well, that is when Max receives an interest payment, which is great. He gets the 40 grand, but is then informed that Paddy is in serious financial difficulty. So as soon as you see that phrase, you should be thinking stage 3. Stage 3 means there is objective evidence of impairment, and as such, we need to increase the loss allowance. And the way we calculate that loss allowance is to compare, if we go back to my notes, the way we calculate the loss allowance is to compare the carrying value of the asset with the present value of the revised cash flows on the asset, discounted using the original discount rate. Okay? So if we go back to the illustration, they tell you that now Paddy is only able to pay 50% of the capital back in 2 years' time. So these are going to be the revised cash flows. These are going to be the revised cash flows, okay? So when we calculate the loss allowance, I know it's in the notes, but I'm just going to rewrite it in a slightly clearer way, I think. We look at the carrying amount of the loan prior to being classified as stage 3. So the loan had a par value of 1 million, but of course we had created a loss allowance of 37.5 thousand. So the carrying amount of the loan just prior to stage 3 would have been $962,500. Okay? We now compare it to the present value of the revised cash flows now that Paddy tells us he can't pay us all the money. And luckily they've done the calculation for you over here. Okay, so it's 462,278. Take one away from the other. And we're going to get 500,222. So that is the value of your loss allowance. Okay, so notice this is calculated in a different way to if the assets had been classified as stage 1 or stage 2. We've got the loss allowance of 5. We've got the amount to recognize now of 500,222. So that is going to be debited into the P&L. Okay, that's going to be the amount we record as an expense. Debit P&L, credit the allowance. But remember, Paddy did still pay that 40 grand for the year, so we still recognize it as a debit to cash and a credit to the profit and loss account. Okay. The final thing we need to say about this asset is that because it is classified as stage 3, any subsequent interest income we recognize on the asset will be based on the net carrying amount of 462,278. Okay, so notice the difference here. Notice the difference between what is happening in this table and what we saw previously. Before we were recognizing income using the 4% based on the gross carrying value, and now we are calculating interest still based on 4%, still at 4%, but based on the net carrying amount. Okay, based on the net carrying amount of the asset. Okay, so that's one of the big differences between stage 2 and stage 3. In fact, that's the main difference. Any effective interest is calculated based on the net carrying amount. Okay, beautiful. So we spent quite a bit of time on that. Just wanted to make sure everyone is happy there with the double entries. Luke asks, could you clarify what we need to know for the exam regarding presentation and disclosure? So in terms of presentation, you may very well be asked to redraft a section of the statement of financial position. So you need to know what the carrying amount is to reflect on the SFP date. Okay, so that's going to be your loan minus any loss allowances, minus any other maybe payments or so. Okay, it's going to be the carry forward value in your table. Now, in the previous illustration, we looked at financial assets which were classified as amortized cost. Okay? In the next section, we're going to look at financial assets in debt instruments measured at fair value through other comprehensive income. Now, remember that because they are measured at fair value each year, that already accounts for any kind of credit losses. Okay? Now, there's a problem there because if we restate the asset to fair value, that already accounts for losses expected from default. If we then deduct that value by the loss allowance, well, the asset is going to be understated, isn't it? Okay, so when we post the double entry for our loss allowance, okay, a little bit strange, but we actually recognize the loss allowance in other comprehensive income. As such, your double entry is actually to debit the P&L for any movements in the loss allowance and credit other comprehensive income. What I like to think is, if you've revalued the asset downward, partly because of credit losses, well, that downward valuation would have been taken to other comprehensive income, in line with the treatment of debt instruments classified as fair value through OCI. But because the fall in value related to credit losses, well, the standards say we need to take that to the P&L. So by doing this double entry, what you're doing is taking the credit loss out of other comprehensive income and putting it into the P&L. It's like taking a little bit from there and putting it elsewhere. You're taking it from OCI, putting it to the P&L. And it says in the notes, this transfers part of the fall in fair value from expected credit losses from OCI to the statement of profit or loss. With that in mind, let's take a look quite intimately at Test Your Understanding 8. So on the 1st of January, Corma purchased a debt instrument for its nominal value of 5 million. Transaction was at fair value. The business model is to hold assets to collect contractual cash flows, but also sell if investments with higher returns become available. Okay, so that sounds like fair value through OCI to me. Interest is received at a rate of 4% annually, and the effective rate of interest is 10%. So 4 is your coupon, 10% is the effective rate. At December, the fair value was 4.5 million. There has not been a significant increase in credit risk. Therefore, we keep the classification at stage 1. And the 12-month expected credit losses are 300,000. Okay, so we're going to take a look at the accounting treatment. You can probably do it on the next page, but I'm just going to get a clean sheet out because we should write all our responses nice and big and clear so they're a good reference tool for this open book exam. Okay, so initially, we record the asset at fair value plus transaction costs, because of course this is fair value through OCI. In this case, there are no transaction costs, so all we're going to do is debit the asset and credit cash. Subsequently, we need to amortize the asset, but also revalue. Our brought forward value was 5 million. We accrue interest at the effective interest rate. We knock off any cash receipts. Okay, so that is of course going to be your 5 million loan multiplied by the coupon rate. Okay, so that's your carried forward value, but because we need to revalue this asset at year end, we're going to have an extra column for the fair value. They tell you that was 4.5 million. So your difference, okay, your balancing figure must go into other comprehensive income. You can see in this case, it is a loss of 800,000. Okay. double entries are going to be a debit to the financial asset, credit to the P&L for the amount of interest income. The cash payment will be a debit to cash and a credit to the financial asset. And then we revalue the asset. Okay, so here we're going to have a debit to other comprehensive income, 0.8. And we credit the financial asset, 0.8. Just give you a moment to jot that down. Okay, so just gave you a moment then to jot that down. Okay, so here we can see that we've got a revaluation loss on restating the asset from its carried forward value of 5.3 down to 4.5. So we've got this loss going through other comprehensive income of 800,000. However, of this overall loss of 800,000, we know 300,000 relates to credit losses. As such, what we're going to do is transfer. What we're going to do is take out 300,000 from other comprehensive income and bung it into the statement of profit or loss. Okay? So the double entry, debit the P&L and credit other comprehensive income. Okay? Beautiful. This transfer we did at the year end, guys. So every year you're going to revalue the assets to its fair value. So this is the treatment for assets classified as fair value through other comprehensive income. Okay? The initial fair value of 5 million that we record at the beginning, that takes into account any kind of credit risk that's already wrapped up in the fair value. So with these kind of assets, okay, we do the transfer for the loss allowance at the end. Okay. Beautiful. So that all seems like a lot of work. You may be pleased to know that there is a simplified approach for trade receivables. Not much to say there, except that for trade receivables which do not have a financing element, because if they did, they'd have to follow IFRS 15. For trade receivables, the loss allowance is measured at lifetime expected credit losses. Okay, so you don't have to bother trying to work out the difference between 12 months and lifetime. Just use lifetime. It makes life a lot easier. Okay. That takes us to the end of impairments, so I can knock that off my list. I got so excited last week. I got so excited last week because I was reading the FT, really good paper. It was March 17th actually, but I was reading the paper. Okay, I love this newspaper because it does have a lot of information on accounting in it. And I was so excited. I couldn't wait to teach corporate reporting because they mention IFRS 9 in particular. It says IFRS 9 makes lenders more susceptible to highs and lows of the economic cycle. New accounting rules could cripple parts of the banking sector by forcing earlier recognition of loan losses. Okay, so that's the expected loss model, isn't it? We have to look into the future and think about all the losses we expect to incur in 12 months or the lifetime. Given the pandemic we are currently going under, this is going to be a real big concern for banks, and they're not going to have historical data on which they can rely on to estimate these losses. So I think there's going to be a lot of to and fro with the auditors about the IFRS 9 impairment rules at the minute. I also saw this great quote from a European banking executive. IFRS 9, I hate it as a rule, but relaxing standards in a crisis doesn't look right. Oh, that was so good. So I'm going to share this with you. I'll put it on the My Update section because I always think it's nice if we kind of bring things to life a bit. And, you know, IFRS 9 is going to be a big deal. It's going to be a huge deal for investors and entities with financial assets. Okay, how on earth are they going to measure those impairment losses? Okay, I don't know if some of you said you were in BCM audit, in banking audits, but this may be of particular interest to you, so I will share that at the end of the day. Right, derecognition then. So that is about when we get the asset off our books, okay? When do we remove it from the statement of financial position? Well, the key word, or the key words here are risks and rewards. So the entity should get rid of a financial asset when it transfers substantially all the risks and rewards of ownership to another party, or else the contractual rights have expired. So in the context of a loan note, maybe you've just come to the end of the loan term, and in this case, the asset redeems, okay, when it's time for redemption. Now, when we talk about the transfer of risks and rewards, sometimes it's not very obvious or very clear-cut. We really need to analyze the detail in the question carefully to determine who has kept the risks and rewards. Particular scenarios that cause problems are repurchase agreements and factoring agreements. So a repurchase agreement, sometimes called a repo, is where a company sells an asset and simultaneously enters into a contract to repurchase that asset at a future date. Okay, so I'm selling it to you today. So presumably, on the surface of things, it looks like I don't really have the asset anymore. I should derecognize it. But then I promise to buy it back in the future. Okay? Should I derecognize? Should I not? I don't really know. You have to examine the detail in the question carefully. One thing I always do is I ask myself, if the asset rises in value, who keeps that gain? Or who benefits? Okay. Whoever benefits is the one that has maintained the rewards. If the asset falls in value, who suffers? Okay, they're the party that's likely kept the risk on. Okay? So sale and repurchase agreements are a common example of where this issue may arise. We've then got this idea of debt factoring. Okay? I like debt factoring. I actually, when I was in audit, the first time I ever went to a debt factorer, because I audited a debt factoring company, was a little business up in Watford. Okay, so it was in a cold, stuffy audit room, but that was where I met my husband. He was also an auditor, and so we were both stuck there auditing this little debt factoring company. So I always remember that. I always enjoy teaching this bit. Anyway, so what on earth is a debt factor? Well, a debt factorer is an entity that buys receivables from another company. Okay? So maybe I'm sitting on a book of receivables. Maybe I'm owed £100 from my customers, but I don't have time to wait. I need the money today. So I could sell the rights. Okay, I could sell the rights to that receivable to another party, to a debt factorer. Okay, that's what they do. They buy receivables from other companies, but they usually buy them at a discount. Okay, so maybe I'm owed £100 now. I can't wait, so I sell my receivables to get the cash in today, but I have to get a discounted price. Okay, maybe a percentage of the full receivable. Fair enough. Now, whether we de-recognize the receivable or not depends on whether the arrangement is with or without recourse. Okay. Just got a question from Rachel. Could you clarify the note on who benefits if the asset rises in value? Yes, absolutely, Rachel. That's right. So if the asset rises in value and you get to keep the gain, that means you've got the rewards of the asset. If the asset falls in value and you have to suffer the loss, that means you have the risks of the asset. Okay? That's generally what we mean by risks and rewards. Who gets the upside, who gets the downside? And, you know, we're looking at the balance of who has the most. Okay. Now, going back to debt factoring, when you sell your receivables, the question is, do I de-recognize it from my financial statements? The answer is that it depends. If the factoring arrangement is without recourse, then what that means is even if the debt factorer can never claim those receivables from the customers, they can't go knocking on your door again. Okay, you're selling it, you've washed your hands, clean, okay, it's got nothing to do anymore. So you sold them without recourse. Okay, you don't offer the factorers anything if they can't recover all the money. And in that case, the company has passed on the risks and rewards of the asset and therefore can de-recognize. Okay? So you've sold your receivables to a third party. You have no further consequence. It's done and dusted. Put it away. We de-recognize the asset. However, if the factoring arrangement is with recourse, then what that means is you've sold your receivables, but the company has guaranteed, you have guaranteed the future performance of the receivables, and you will compensate the factorer if they can't get back any of the money. As such, it doesn't seem like the risks and rewards have truly been transferred. Okay? We will have to closely examine the situation further. So where we've got a situation with recourse, it is unclear. Okay, we need to examine further. With that in mind, let's go to the next page and look at a few examples. So here we're just going to have a bit of a discussion. ABC sells an investment in shares but retains a call option to repurchase those shares at any time at a price equal to their current market value at the date of repurchase. So I sell some shares today, and I can buy them back in the future at whatever price the market rate is, at whatever price the fair value of the shares is in the future. Okay? So if the value of the shares increases in the future, who benefits from that gain? Is it me or the other party? Okay, it's the other party, isn't it? Thank you, Nicholas. Because if the shares rise in value in the future, well, I need to pay that increased value in order to repurchase them. And that means the buyer gets to gain from the increase. Conversely, if the shares fall in value in the future, I gain because I can buy them back at a lower price. And therefore the risks lie with the buyer yet again. Okay? So in either case, it looks like the risks and rewards have definitely been transferred to the buyer. I'll just put R&R for short. And as such, we derecognize. If I could spell derecognize. Ooh. So thank you, Luke. Thank you, Nicholas. Okay, you are on the right lines. We do derecognize because the buyer benefits. Let's look at the second example. And we're just having a discussion here. Okay, so have a think about it. Hold off, even if you're confident on the answer, for just a few seconds. I want everyone to have a go. DEF enters into a stock lending agreement where an investment is lent to a third party for a fixed price for a fixed period of time. So DEF is lending some stock to a third party, but it is only for a fixed period of time and for a fixed fee. So you're letting go of the stock for a little while, but you are going to get it back very soon. What do we think? Has the risks and rewards transferred? Sam thinks risks and rewards stay with DEF. Luke agrees. Tiffany thinks risks and rewards not transferred. I would agree with you, okay? Because regardless of whether the value of the stock increases or decreases, you're still going to get it back, okay? You're only lending it out for a period of time. And presumably when you get it back, any rise or fall, you get to keep the benefits of, or you get to suffer the risk of, okay, if there's a fall in value. So R&R is not transferred. We keep on the balance sheet. Okay, XYZ sells title to some of its receivables to a debt factor for an immediate cash payment of 90% of their fair value. Okay, so they receive 90% of the fair value. We normally call that a haircut. The terms of the agreement are that XYZ Co. has to compensate the factor for any amounts not recovered by the factor after 6 months. So if the receivables are irrecoverable, XYZ forks out on the loss. What do we think? Derecognize or keep? Okay, thank you, Edward. Thank you, Tiffany. Thank you, Rafi. Thank you, Sam. Okay, we keep. Because this is a debt factoring arrangement with recourse. Okay, If the receivables are irrecoverable, then XYZ have to bear the risk. Okay, they're the ones that lose out because they have to pay the factor for any lost amounts. Okay. What happens after 6 months? Good question, Luke. So 6 months is basically how much time the debt factor has to collect the receivables. Okay, and that's the cutoff point. If they haven't managed to recover any money by that date, that is when you are going to have to suffer the losses on those receivables. That's when you record a bad debt expense and pay the factor for any amounts not recovered. Let's go to the next test your understanding, because this is another example of a factoring arrangement without recourse. Okay, and I'm going to go to the double entries. Okay. Oh, very good question from Luke. So it says, do we write off the 10% of the debt initially? What do you think that 10% represents, Luke? Sorry, not to pick on you, but you've sold some of its receivables. You've sold your receivables for 90% of their value. So you only got 90% of the value back. You have to take a 10% hit. Okay? So that's going to be a cost for you. What kind of cost do you think that is? Beautiful. Thank you very much, Kent. Okay, first time I've seen your name in the chat panel, but you come in there. Whew. Great comment. Okay, great contribution. You are right. It is a finance cost. Okay. Thank you, Jayon. Time value of money. So that is kind of similar idea to a finance cost. This 10%, we'll call it a 10% kind of, we'll just call it the 10% not received is treated as a finance cost in the P&L, but we recognize it over the period of 6 months. If we think about it conceptually, it's the cost of you basically borrowing this money from the debt factor. Okay, so you need some cash now. You're effectively securing it against the value of your receivables. Okay, and you're not going to get the full amount. You're going to get a little bit less. Well, that's the cost of this kind of finance. Okay, that's the cost of getting an advance on your receivables. Okay, so we treat it as a finance cost spread over the period to which it relates. Let's go through TYU10 in a bit more detail. So here we've got an example of factoring without recourse. Take a minute to read through the detail, have a read through it, and then we'll talk about it together. Okay, so here we've got a situation of debt factoring without recourse. Okay, so that means you can de-recognize the asset. It means you haven't passed on the risks and rewards, but it's a little bit more tricky than that. Okay, so let's take a look in detail. So M has trade receivables of 8 million, of which 5 million are not due for 3 months, so they're sold to a debt factorer. So you've got 5 million of receivables you sell on to a debt factorer who advances cash of 80% of that gross receivable value. A credit protection premium of 1.25% of the gross receivables would be payable. Okay, so we need to add a cost of 1.25% of the gross receivables together with interest of 1% per month on the amounts advanced net of any cash received by the factorer. Okay, so this is the cost to us of selling 5 million of the receivables to the factor. Okay, we are paying some kind of credit protection premium, and we are paying interest on the amounts we've borrowed, okay, or the amounts we've been advanced from the debt factorer. After 3 months, all remaining amounts would be paid by the factor to M, and further responsibility would belong to the factor. That means the risks and rewards have transferred. We can de-recognize the whole receivable. So let's think about what's going on. Okay, we'll break it into chunks. So we have receivables of 8 million. 3 million pounds is retained. So we continue to recognize. £5 million is advanced to the factorer. %80 of the gross value. In other words, £4 million is received from the factorer. They do tell you it is non-returnable. As such, what we can do is debit cash, the amounts received, and credit receivables. I am happy that we can de-recognize the 4 million of receivables entirely because the amount is non-returnable. There is no recourse attached to this advance. For the remaining 1 million, it is a bit less obvious. Okay, so we are told that we need to pay a protection premium. That protection premium is calculated as 1.25% times the gross value of the receivables, it says. Okay, so that's going to be 5 million, giving you 62,500. As well as that, we need to pay 1% interest on the cash advanced. So that's going to be 1% times the 4 million we've received times 3 months. That will give you an amount of 120,000. So in total, we have finance costs of 62,500 plus the 120, giving you 182,500. Okay. Debit finance costs. and credit your cash. This is the amount you are paying to the debt factorer for the amounts that have been advanced. At the end of 3 months, the risks and rewards have been transferred, and they tell you that all remaining amounts would be paid by the factorer to M Limited, and any further responsibility would belong to the factorer. So the risks and rewards are transferred, and the remaining amount paid to M. We are going to debit cash and credit receivables. Okay, so quite a long story going on there, but you can see that what I've actually done is just follow the instructions from the question. Okay, what I've done is just follow instructions from the question. What Emma's done is sell the receivables without recourse. As such, it can de-recognize the receivables as and when it receives the advances from the debt factorer. Okay, but because it's receiving the advance early, before the receivables are actually due, well, M's going to have to pay interest for that advance, pay interest for getting the cash up front, even though the receivables weren't due until 3 months later, and that comes at a cost. Okay, and so that's going to be the 182,000. It's the protection premium plus the interest on the amounts advanced. Now, to be honest, this is quite a complicated question. Okay, it doesn't tend to be that bad or that tricky, but detail here is the takeaway message is to read the detail in the question carefully. What I have done here is just follow the steps as per the test your understanding. So hopefully everyone has jotted that down. I'm going to change the page unless anyone says otherwise. Okay, de-recognition off my list. So it does look like we've got 4 things left to do. Let's manage some expectations. I think we will have a finish time slightly better than yesterday, more around the 5 o'clock mark. Financial liabilities will take a while. The other three parts we should get through fairly swiftly. So let's now focus on financial liabilities. Okay, I feel like we've given a lot of love and attention to the assets, but what about the other side? What about the liability side? Well, the good news is that when it comes to financial liabilities, there are only 2 categories to consider. There are financial liabilities at fair value through profit or loss, and then there are financial liabilities held at amortized cost. Okay, just 2. Financial liabilities classified as fair value through profit or loss include any liabilities held for trading or acquired for the purpose of selling in the short term. And this includes all unfavorable derivatives. So remember what we mean by that. The derivatives that are out of the money. It also includes the designation of any financial liabilities that normally would have been accounted for under the amortized cost method. So it is possible under IFRS 9 to designate a liability to be fair value through profit or loss when it would normally have been amortized cost. So this designation is what we call the fair value option. You can go for the fair value option if you want. Just treat it all as fair value through profit or loss. That's usually done to reduce any accounting mismatches, if indeed that liability is meant to offset another instrument, okay, and there's a difference in accounting treatment. You're going to see that later when we look at hedge accounting, so don't worry too much about accounting mismatches for the minute. Okay, it will be explained later. Financial liabilities at amortized cost are basically anything else, okay? Now, how should we recognize the financial liabilities? Well, initially, the liability should be recognized at fair value, which is going to be the proceeds received, okay? Now, if the liability is classified as fair value through profit or loss, then any transaction costs are expensed into the statement of profit or loss, okay? So in that case, your double entry is going to be to debit cash, the proceeds received, you're going to debit cash the proceeds received. You're going to credit the financial liability, proceeds received. You're also going to debit the P&L for any transaction costs and credit cash for the amount you pay on the transaction costs. Okay, so that is the treatment if the liability is classified as fair value through profit or loss. Okay. We only record the proceeds received as part of the liability. Transaction costs go straight to the P&L. If the financial liability is classified as amortized cost, then we need to deduct the transaction costs from the initial fair value. Okay, so we're netting the transaction costs, how much we pay, against the proceeds we receive from the issue of that liability. So we take the proceeds received less the transaction costs, and that is going to give you your initial value for the liability. Debit cash, the net proceeds, credit the financial liability. You may remember that from back in FAR. Okay, that's how you used to do the treatment at the professional level. Just give a moment to finish jotting that down. Okay. That was the initial accounting treatment of financial liabilities. Subsequently, depending on the classification, okay, we either revalue the financial liabilities to fair value with gains and losses going to the P&L, or we amortize the liability. Okay? Just go back to the notes so everyone can finish jotting them down. Okay, so the good news with financial liabilities is we already know how to do the subsequent accounting treatment because it follows the same idea as fair value through P&L assets and amortized cost assets. As such, test your understanding 11, I am going to let you have a go at for homework. It's basically another amortized cost table. Now, we're issuing a liability here, not buying an asset, but the skill for doing the calculations is the same. Okay, so TYU 11 can be done for homework. TYU 12, we're going to have a go at together. Okay, because TYU 12 includes a little bit of foreign exchange into the mix. Okay, so we're spicing things up a little bit. And I'm going to be testing your knowledge here of IAS 21 on foreign exchange. We actually covered it this morning, so I'll be very upset at anyone who can't contribute when I ask you a few questions. So we are asked in this question, in this test your understanding, to determine how the foreign loan would be accounted for per IFRS 9 and IAS 21. Remember, that's your FX account, FX standard. And remember that in corporate reporting, they are allowed to mix and match standards. Okay, you may very well be examined on an issue that must consider two different sets of accounting rules. They are two different standards. So in this question, we see that X Limited issues 6% £100,000 loan on the 1st of January, repayable in 3 years. Issue costs were £2,000. The effective rate of interest is 6.8, and we've been given exchange rates as follows. So we've got the value on issuance. Okay, so that must be the historic rate. We have the value at year end. That must be my closing rate. And we've got the average rate, which they've given you here. Pound is the functional currency, and yet the loan has been issued in dollars. Okay, so what we need to do is amortize the loan and translate it into pounds. What are we on? TYU 12. So initially, because we have a financial liability, we record at fair value net of transaction costs. Okay, so the loan was issued for $100,000. Knock off the issue costs of 2. Here we've got a value of 98,000. Now this is of course in dollars. I need to get this value into pounds, don't I? So I need to translate it at the historic rate. $98,000 at the historic rate of 1.2 is going to equal, if I plug that into my calculator, 81,667. Debit cash, debit cash, credit my financial liability. Okay. Subsequently, we must amortize the loan. Now, when we do this, you need to amortize it in the original currency and do the translation at the end. Okie doke. So my brought forward value, $98,000. Remember, we're doing this in the original currency. Okay? We accrue interest at the effective interest rate. I think that was 6.8%. That gives me interest of 6664. We knock off any cash associated with the liability. Remember that this paid a 6% coupon. So 6% times the 100,000 is going to give you an annual coupon of $6,000. So my carried forward at the year end is going to be 98664. So we know the value of the liability in dollars and we know the interest we've accrued. However, we need to translate all of this into pounds. So you tell me, at what rate do I translate the 98,000? Okay, the 1.2. Thank you very much, Sam. We use 1.2, which was the opening rate. Okay, which was also the date that the liability had been issued. At what rate do I translate the finance cost? 1.35 average rate. Thank you very much. And the cash flow, assuming it occurs on the last day of the year, 1.4. Absolutely. And what about the carried forward? Same. Thank you, Sam, at the 1.4 as well. So these are both the closing rates. So get your calculators out and let's see the value in pounds. Well, we already calculated the opening value. It's 81,667. The interest is going to be at 4936. And the cash flow is going to be 4286. My closing value, 70,474. Now, in theory, the brought forward value plus the interest minus the cash outflow should equal the closing value. But it doesn't. Okay, if you put these numbers into a calculator, you will see that the left-hand side does not equal the right-hand side of the equation. That is going to be because there is a foreign exchange gain or loss element to this question. We have translated different parts of the liabilities using different FX rates, so we are going to end up with an FX gain or loss. You need to insert the balancing figure to make this transaction, to make this equation work. Anyone want to tell me what that is? Nicholas asks, is cash always assumed to be received at the end of the year? Yes, assume so unless told otherwise. That tends to be the case. Thank you very much, Sabine. You have given me the missing figure. So the balancing figure is going to be 11,843. We are going to have to add that so it becomes a foreign exchange gain. Okay? Now, for completeness, let's write out all the double entries so we're happy with the treatment. Okay, the interest is going to be a finance cost in the P&L. The coupon is clearly a reduction in the financial liability. And that FX gain is going to be also an adjustment to that liability. Just realize that should be a negative, shouldn't it? Okay, beautiful. Just give you a moment to finish jotting that down. Okay, so this incorporates skills that we've already seen. We know how to amortize assets and liabilities. The only difference is now we are going to be, now we've got foreign exchange in the mix. That is not a stupid question at all, Sabine. Okay, is this gain taken to P&L or OCI? I'm going to test you. What did we learn this morning in single company financial statements? What kind of item, or another way to put it, is a loan a monetary item or a non-monetary item? The monetary item. And we said with monetary items, we would retranslate them at the year end. Any gains and losses go to the P&L. Okay. So not a stupid question at all. FX gain goes into the P&L. Okay, beautiful. We've got a few other bits to tick off with regards to liabilities. When it comes to the derecognition of a financial liability, an entity shall remove the liability when it is extinguished. Okay, in other words, when you pay it off. Easier way to think of it. If there's any difference between the carrying value of your liability and how much you've actually paid off on it, then that difference is a gain or loss on derecognition. Okay, we take it to the P&L. Now, we've got this section here on exchange or modification of debt. Okay, the idea here behind exchange or modification is, let's say you are struggling at the minute. Okay, it's quite pertinent in this in these current economic times. So you've issued some debt and you are struggling at the minute. You can't afford to make your next interest payments, so the bank modifies the debt. Okay, they change the terms of the debt. So, you know, maybe they change the rate. Maybe they change the term. They alter some aspects. They modify the contractual terms of the debt. Okay? Well, in that case, what we might do is derecognize the current liability and re-recognize a new liability, but it really depends on whether the new terms are substantially different to the old terms. Now, what on earth does substantially different mean? Well, we can quantify it. To be substantially different, the present value of the cash flows under the new arrangement, including any necessary fees, must be at least 10% different to the present value of the cash flows under the original arrangement. Okay? So you're basically comparing and contrasting the fair values of the old loan versus the new loan. Okay, if the present values are greater than 10% different, then we need to de-recognize the own loan and re-recognize recognize a new liability. Okay. They've given you the instructions below. Okay, so your double entries would really be to debit your financial liability. That's the old loan, shall we call it. Credit a new financial liability. Let's call this the new loan. Any balancing figure will go to the P&L. That's assuming the difference is greater than 10%. If the difference is less than 10%, well, in that case, we do not need to de-recognize the liability. However, we restate that liability to its new present value. Okay. Any difference is taken to the P&L. Beautiful. Not much else to say there. There isn't a worked example on it, but we've got it there in your notes. You just need to put it into practice should it come up, although it's not a heavily examined area. Have I missed any sections? I feel like I've missed something. If we go back to question 6.3, so page 185, this is an interesting aspect of financial liabilities that I like. Now, let's think about this. When we value financial assets and financial liabilities, we determine their fair value from the perspective of the holder. When we look at financial assets and financial liabilities, we usually determine the fair value from the perspective of the holder. Now, I ask you a question. Now, I'm going to ask you a question. I've borrowed some money, and I'm going through financial difficulties, okay? I've had a drop in my income, I can't afford all my expenditure, and I definitely cannot service all of my debt, okay? As such, for the liability which I have issued, is the fair value of that liability going to decrease or increase? I have borrowed some money and I am struggling to pay that money back. Will the fair value of that liability increase or decrease? Okay. So thank you for your contributions, Mark and Jayun. You are right, it would decrease because we're valuing it from the perspective of the holder. And if I am less likely to be able to pay that money back, the fair value of it drops. Now, if the liability is classified as fair value through profit and loss, let's think about the double entries here. If the value of my liability has fallen, what I would do is debit the liability and credit the P&L. Now that doesn't sound quite right, does it? Because a credit to the P&L is a good thing. Okay, it means I've earned some income in the statement of profit or loss. Now, that doesn't seem quite right, because if my credit quality has deteriorated, if I have become less creditworthy, it doesn't seem right that I get to recognize a gain in my P&L because I am suddenly more of a credit risk. So for this reason, hey, we don't want to be recognizing gains because we aren't doing so well. For this reason, any element of a new valuation gain that's related to the deterioration in my own credit quality is taken to OCI, not the P&L. So sadly, that is not the case. What we're going to do is debit the P&L other way around, my apologies. We're going to debit the financial liability and we're going to credit other comprehensive income, the amount or the deterioration related to my own credit risk. Okay. Lovely. So really, really small part of the syllabus, but I just thought it was really interesting. I think it's quite a good rule. Right then. So moving on into the text, derivatives and embedded derivatives. So not much left to say here. Okay, we are, pushing through. Near the end, let's knock financial liabilities off. Just finished going back to the notes so everyone can finish jotting that down. The last bit we have to go to look at are derivatives. Now, we've seen derivatives in the past, haven't we, from back in your financial management days. So same kind of idea here. I won't focus too much on derivatives because we're going to see them come up again in hedge accounting in a later chapter. Okay? But let's just remind ourselves of the definition of a derivative. Okay? So there are 3 bits of criteria that help us identify derivatives. Okay? So the first one is that the value of the derivative is derived from the value of an underlying item. Okay? So hence the name derivative. Okay? The value is derived from an underlying item. Underlying items could be interest rates, currency rates, commodity or equity prices. So let's say I have committed to buying some wheat. No, I'll use cocoa beans because I'm addicted to coffee. I have committed to buying some cocoa beans in the future for £1. £1 for a certain unit. If the market value of the cocoa beans increases, then I have a gain. Okay, the value of my contract to buy the beans for £1 goes up because if the actual prices of the beans increase, I have locked in a more secure price. Okay, that's what we mean by the idea of a derivative. It is very much revision from FM. They usually require no or small initial investment. So the initial value is usually 0. In what situation would we have to make an upfront payment on a derivative? In what situation would we have to make an upfront payment on a derivative? Thank you, Edward. You are right. You are talking about in the situation of options. There may be a small initial investment, and that is related to the option premiums. Although they tend to be a very small fraction of the total exposure of the contract. Okay, so we say it's a small initial investment. And also, the derivative is sold at a future date. So you may get a mark for being able to discuss these points, for identifying a contract and relating it to these definitions. We have examples of underlying items and derivatives. I'm just going to write a couple of extra notes on derivatives to remind us, what they are, how we account for them. Okay? So first thing I want to write about derivatives is that all derivatives are classified as fair value through P&L. Okay, great. No question about it. Let's do an example so we all remember what derivatives are. Okay, so let's say I enter into a forward contract to buy gold at $1,000 per ounce. initially, because we said by definition derivatives have a very small or nil initial value, we do nothing. Okay, there's nothing to record. Subsequently, the treatment depends on movements of the underlying item. So let's say gold prices fall. You are locked into a disadvantageous rate. So in other words, you're out of the money. Let's say the fair value is £5,000. What you're going to do is debit the statement of profit or loss and credit a financial liability. Okay? So because we've got a derivative that's out of the money, that means that actually fits one of the definitions or examples of a financial liability. Okay? It's a contract to exchange financial instruments on unfavorable terms. So we have a financial liability. Okay? Now let's say we're going fast forwarding to the next reporting date. Let's say the gold prices rise and you've locked in a favorable rate. Let's say the fair value has now increased to positive £3,000. So now we've got a gain. Okay? Now observe the double entries. Currently, we are holding a financial liability at £5,000. Okay, it's got a negative value. We are in a liability position. It is now increased in value by £8,000. Can you see? Because we're going from a credit of 5,000 up to a debit of 3,000. So we're actually recognizing an overall gain of £8,000. We're going to have to credit the P&L 8,000. In terms of the debit entries, it's going to be broken into two parts. We clear out the financial liability we were previously recording at 5, and we record a financial asset with a value of 3. Okay? So I guess the point here is that with derivatives, they can flip between liability to asset position. I always think of it like a lever going like this, then like that, like this, like that. And it could be like this for any given reporting period. Okay? Just give you a moment to finish jotting that down. Okay, so I'm going to carry on, move on. The remainder of the chapter is on embedded derivatives. I don't want anyone to get too stressed about this. Okay, have a read through it, look through the illustrations, but notice the icon, it is home study. Okay, so have a read through, nothing to get stressed by. We've got a few pages on embedded derivatives. All right. A convertible debt instrument would be an example of an embedded derivative. Okay. You've got a few other examples in the illustrations, but not a big deal for corporate reporting. So we can knock derivatives off the list. financial statement disclosures, basically, ever since the global financial crisis, companies have been required to make a lot more disclosure on the risks that are attached to any financial instruments they invest in. Okay, so what's the true risk? And a lot of the time, the risks were unquantified in the past. Okay, that's why we had the global financial crisis in the first place. You had all of these bad loans, you had the securitization of all of these bad mortgages, and that risk wasn't truly recognized by investors. So all of these different instruments were just being sold around without investors truly understanding the underlying risk. As such, IFRS 7, okay, has some quite stringent rules in there about giving information on the significance of financial instruments to a business and the extent of the risks arising from those financial instruments. So have a read through this in your own time. But what I would say is that this is an easy win. This is an easy win if you had maybe an audit and assurance question around financial instruments. Okay, so one of your audit risks may be that disclosures are not adequate. Okay? Because we know that the disclosures are complicated. We know that a lot needs to be divulged in terms of both the qualitative and the quantitative risks. You, as the auditor, would be worried they are not complete in the financial statements. What would be a good audit procedure if you're worried that the disclosures are not good enough? What are you going to tell your audit juniors to do? Oh gosh, you do things far more thoroughly than back in my day in audit. Consult with the experts. There we go. Read them. Read them. Thank you, Nicholas. That's my favorite. Okay, we'll keep it simple. So yes, you would have probably specialized checklists within your firm. You're going to have a list of, a list of things that need to be included in the disclosures and not. So you're going to go through your checklist and tick them all off by reading the financial statements. Okay, or reviewing them, perhaps. So we can just put review disclosures for adequacy, including and ensure they include both qualitative and quantitative disclosures. Okay, lovely. That's always one of my favorite audit procedures. Okay, review the financial statements for adequate disclosures in line with IFRS 7. So that's all I wanted to say on disclosures. As I said, have a read through. It is quite interesting, and it's an easy win. It's an easy 1 mark for your audit risks and procedures if you get it. Rob is sharing the ICAW helpline for anyone that feels they need a little bit extra support on this. Okay, finally, we end with our audit and assurance. So kind of leads on to the next section, kind of leads on to what we were just talking about before. Wherever you have an entity that has invested in financial instruments or issued financial instruments, there are going to be a lot of risks around it. For example, let's put it out to the virtual room. I promise we won't be much longer. I do have a few closing words, but just put it out to the virtual room. If I have an investment classified as fair value through profit or loss, what is going to be what am I concerned about as the auditor? Think about the initial and the subsequent measurement. What are we worried about? Classification, okay. Let's say I'm happy with fair value through profit or loss. Valuation. Okay, so we are going to be concerned with the fair valuation. Is it in line with IFRS 13? What else do we remember about IFRS 13? It was horrible. Okay, it was horrible. What else do we remember about by IFRS 13? We care about the hierarchies. Thank you, Luke. So, has the fair value been appropriately determined? What is the hierarchy? Hierarchy. Are there adequate disclosures? Are the gains taken through statement of profit or loss? Okay, so these are the risks very specific to the asset. But remember, it's an asset, so we've got all of the other things to be concerned with, such as, does it exist? Does the entity have the rights and obligations of the asset? Okay, is it complete? Contractual cash flows test? Yep, absolutely, Hashir. So probably not relevant in this case, but if we had an investment in debt and we were concerned with the classification, we'd have to ascertain what the contractual cash flows relate to. Is it solely payments of principal and interest? Okay, so I've just put a very small amount of ideas on the board. You've got a nice long list here. Okay, so this is the one I was talking about. Fair value could be hard to determine. You've got a series of really good audit procedures to help you out there. So really nifty tool, a really nifty reference point. I wish I could spend longer on it, but it is 5:07. So I'm going to set this for home reading. Please don't clock off yet, everybody. I do have a few closing words, okay? So I promise I won't keep you much longer. Just a few more words, and then we will be done for the day. Okay, so for the rest of this week, then, you are going to do the rest of your courses. So you've got SBM coming up tomorrow, I believe, and then you have case study Thursday, Friday. So what I just want to talk to you about is basically for your self-managed learning. Okay, we've got 10 days of core SML just for CR and SBM. 6 days are allocated to corporate reporting. 4 days are allocated to strategic business management. Now, there will be one contact day for corporate reporting. It might be me, it might be another tutor, but you will be coming back to the virtual room so we can cover some of the more tricky areas of corporate reporting. Okay, there's a little bit more on financial instruments as well for us to have fun with. Now, at the end of your, I will indeed upload this, G. In fact, it's already up on your, it should be already up on my Kaplan. Okay, it should be as part of the pre-course work. So you should be able to see it on my Kaplan. Just wanted to remind you really of the interim assessment. Okay, so that should be done at the end of your SML. It is still required at the advanced level, and it's still only 60% of a real exam. So you're going to get 2 questions. Okay, it doesn't have to be done under exam conditions, and obviously it's an open book exam, so please use your open book file. Okay, get used to it, get used to organizing it neatly and usefully for the paper. The deadline can be found on my Kaplan. Okay, so if you wanted to take a look, that is going to be listed on my Kaplan. I've just had a question from Edward. Do you know if SGS week will be on the same week as planned, and will there be remote access? SGS week is still going to be in the same week as planned as far as I have been made aware. So yes to the first part of the question. Will there be remote access? Let's wait and see. I think the answer is most probably. Okay, but let's wait and see if the situation changes. The deadline for your interim assessment is going to be listed on my Kaplan. Okay, so I've got the 1st of June for this course. Probably it's the same for all the other courses, but take a look. Take a look at your own My Kaplan version. Okay, there are 3 different groups in this virtual room. Non-submissions will be monitored, okay, so I will be reporting back to PwC on any non-submissions. They may require you to take a day of annual leave if you haven't submitted anything, because they have given you a day of study leave purely to do your interim assessments. Remember, there's one for SBM, there is one for corporate reporting. You will get feedback on your performance and you will know your quartile position. Okay, small group sessions, as we said, let's assume they are going to go ahead live online. It could possibly change, but I don't know. So we'll assume it is going on still live online. Had a question from Vishali. Do I know when you will receive your materials? I am afraid not. No. It will be dispatched to you as soon as we have them available. But we do have a big shortage because at the minute, the ICAW, we don't have any further publications being received from the ICAW. One thing to note, I do believe you all have to complete a form to get your materials as shared by the PwC team. So if you don't know what I'm talking about, when I say you have to fill in a form, go contact the PwC team. You should, I believe they're all being dispatched in one go. Okay, I do believe they're all being dispatched in one go, but have a look. Have a look. If you are unsure about the form or if you think there's been a mistake with what you have received or not, please contact the PwC team. Please contact the PwC team. Okay, icaw@kaplan.co.uk. Now, for small group sessions, there will be a pre-revision mock at the end. Okay, so as always, you'll be examined 2 exams, CR in the morning, SPM in the afternoon. The exam prep phase, I'm going to talk about later, so I wouldn't worry about that now. Exam prep is going to be pushed back to a week before your exam, so sometime in the middle of August, okay? It'll be like exam prep weeks that you've done before, so don't need to worry about that too much for now. Don't forget to check when your contact day is. You will receive an invite to join another WebEx. Note down the deadline for your interim assessment, and don't forget the academic support team. I know, Vishali, about building an exam file. It is frustrating. The only thing I can ask is that you be patient and bear with us. If you have access to a printer, then fantastic. If not, another option may be to build an exam file on your laptops if you've got the function to write on them, like a tablet mode, and then you can print them all off when you're back in work and you can use your employer's printers. Okay, that's the only thing I can suggest for the minute. And I can only apologize for the delay. Everyone is working hard. It's just with the limitations we've had. Don't forget the academic support team. Don't forget the Brightspace Pulse app. So you should all have this by now, I would have hoped. If not, get on your app store, get the Brightspace Pulse app. You can access my Kaplan and all the other modules you are enrolled on via this app. Okay, sorry to have kept you for this long. We're on 5:15, so I'll be hanging out for a little bit longer. Ask any and all questions that you will. For everyone else, if you are completely wiped out, that is fine. Have a lovely evening. Enjoy the rest of the week with Anne Porcheron and your SBM tutor. I think that's Amto, but I can't quite remember. Okay, so good evening, and I'll be hanging around if you have any further questions.